Good morning, everybody. My name is Lynette Waardenhorst, and today I'm going to talk about the new IRBA Code of Ethics. So today, ladies and gentlemen, we're going to talk about the new IRBA Code of Ethics that was released in November last year. You will see that I've prepared about 170 slides, but don't worry, we don't have time to go through absolutely every slide. So I'm going to be very selective. Today, I'm going to talk about the things that I think you should really know, where I know where all the important changes were from the previous Code of Ethics. But what I want to say to you is that the presentation that you've got in front of you now is basically a summary of that whole code. So this could be your reference if you quickly want to look something up, just to come back and have a look at what the code says. It is a very long, detailed code, lots of information. So this summary might just help you to find something quickly. Right, so I'm going to start the presentation now. The duration of the first session will be from now until 10:30. Then we're going to take a break from 10:30 to 11. And then we will go for the second session from 11 until 1. So that is the program for today. What you see on the screen there is just a quote, just the right way is not always the popular and the easy way. Standing for right when it is unpopular is a true test of moral character. So that is just that quote that I want to start my presentation with, because on the next slides, I'm also going to start with going forward, where are we in our profession with regards to ethics? Just going to have a look at a few current issues. And then also, they did say that our regulators did say that they're going to get more stricter with this code. They're going to bring in more penalties for people that are not complying with their code of conduct. So here's just a foreword quickly. This was said by Bernard Agallas. He was the chief executive officer of IRBA. There have been too many recent examples of improper conduct by auditors to continue to believe that it's business as usual. So what I want to say here today, it is not business as usual anymore. We all need to take a very hard and good look at this new code. We also said, what is the use of having standards if those who fail to comply cannot be held accountable? And I think that is the theme for today, is that they did say that auditors and accountants are going to be held accountable if they don't comply and if there's improper conduct on the side of an auditor or an accountant. So this is what they said is going to happen going forward. So I'm just hulle in sy Afrikaans val met die deur in die huis. This is the penalties, as I might call it, for people who are not complying with this code. First, we see the sanctions can be enforced with immediate effect now. Suspension of the right to practice, so take away the license of the auditor. So they want to have more than just a monetary penalty. For a long time, we only had a monetary penalty, but now they also say they're going to suspend this person from having a practice. Removal from the register, publication of the findings and names of the people where matters are in the public interest, and the publication and findings of names of repeat offenders, and the publication of findings in all cases which goes to a disciplinary hearing. So all in all, what they want to look at is close the practice down, remove the person from the register, and what we call name and shaming of the offenders. All right, so you can see that things are going to become very hectic for any person who does not comply with the code. I just also want to focus your attention on something that is new, this compulsory ethics program. I am sure you're all aware of this, but let's just quickly run through it. If you got psycho trainees under contract with you, when there any contract ending after the 31st of March 2019 will be required to attend a compulsory ethics training session. And that session needs to be between 6 and 8 hours. You don't have to do it in one run. So you can break it up maybe 2 hours, 2 hours, 2 hours, or 3 hours, 3 hours, depending on how you want to schedule that. But in the 3-year or 5-year contract, they must at least attend 6 to 8 hours compulsory ethics training. And there is a specific agenda that needs to be covered during that ethics training. So please just make sure that you are aware of this. This is effective from the 1st of January this year then. Right, so that's all psycho trainees that must go through the 6 and 8 to 8 hours ethics program. So I'm going to talk now about the International Code of Ethics for Professional Accountants, including International Independence Standards. Now this is the name of the new code. So whatever you know about the Code of Ethics, I want you to forget about it. What you've learned is the old code. Everybody must switch over now to the new code, and I will give you the implementation date in a few minutes. But forget about the old code. Throw it away. Even your old manuals, your quality control and ethic manuals, those ones that you updated and tailored for your firm, those ones you could now forget about because we need to redo everything again. Now, talking about the manuals and what you need to have in your firm, your policies and procedures, I try to patch the manual, take the old one, and I thought I can take this new code and I can just patch it with the amendments. And then I realized it is totally impossible to do it. It's completely impossible. You will not be able to patch your old manual. And I will show you why, because of those referencing numbers and the wordings and the changes in the new manual. So it is not a small change, it is a big change. Although a lot of the concept stays the same, there's also a lot of subtle changes which you're going to miss if you try just to patch the old manual. So that's why I'm saying that old manual that you've got, please, you now have to forget about that one. We're all going to start from scratch with the new manual going forward. So note the new name for the new standard. Now, what I'm going to do today is I'm going to talk about this International Code of Ethics. This is the international one that was released first. Then IRBA released their code and Psycho released their code. But we'll talk about that a little bit later on. If you're an IRBA member here today, we've got the 3 codes that we need to take note of. And I will explain to you later on how we're going to work with the 3 codes and make it one. So our agenda for today, the introduction of the new code. Then we're going to look at the compliance with the fundamental principles, compliance with the conceptual framework. Now, if you look at these 2 things, this sounds familiar because we also had the same things in the old code. And so that's why I say that a lot of the names and things stays exactly the same. Some of the principles stays exactly the same, but there are some subtle changes. Even within this fundamental principle and the conceptual frameworks, there's some changes that you need to take note of. Identify and evaluate threats to compliance with the fundamental principles. Then we're going to look at our independence requirements applicable to assurance engagement. So that is if you do audits or independent reviews or attorney's trust account audits, state agents audits, any assurance work that you're going to do. I am going to focus on public interest entities because this is a big one. I do have reportable irregularities summarized for you in the presentation as well, just to make sure that everything is complete. But I don't think we will have time to discuss this. I'm sure you're all familiar now with the reportable irregularities definitions and the reporting process. So today I'm not going to focus on that. I think we're going to run out of time. But I did bring it into this presentation so that we just have everything together. And then lastly, responding to non-compliance with laws and regulations. So although the principle stays the same, the wording is completely different in the new code of ethics that I'm going to show you now. So where are we at the moment? Why were there so many changes? So as I said, we've got a new code. This then replaced the 2016 handbook and code of ethics for professional accountants. Yesterday, I received an email, and I'm sure you did too, from IRBA. The 2018 handbook is now being released. So please forget about all your old handbooks. Throw them away. Please make sure you go and you download the 2018 handbook. You just go onto their website and you can download this electronic format. Delete all other previous copies so that you don't accidentally refer to an old copy. What's included now is the no-clock pronouncements. Although we've been talking about that for quite a while now, they have now included it in the handbooks. Then addressing the long association of personnel with audit or assurance client. This is new. Today I'm going to take you through the new procedures, the new periods that you need to look out for, especially if you've got public interest entity audits. There's major changes to this. The time periods from when you can be are allowed to be the auditor, that has changed, or the cooling off period has also changed. So you will remember for public interest entities in the previous code, we said you can be the auditor for 7 years, and then you have to go and cool down for 2 years. Now this has changed. This cooling off period is now anything from 2 years to 5 years, depending on the position that you fulfill. Then the preparation and the presentation of information and pressure to breach the fundamental principles is also something that they've included in here. Also inducements, gifts, receiving gifts. There's a whole section now just on that. Where we had 1 or 2 liners in the old code, there's now a whole section about receiving gifts. And I'm also going to talk to you about that today in detail. It's still principle-based, although if I look at the way that they've structured the new code, I don't see much. There's a lot of principles. There's still a lot of principles, but I see a lot of rules. I really see specific rules where it comes to threats and where you need to apply your safeguards. So the standard gives us now more specific safeguards for a specific threat. And I'll just take you through this just for you to get the hang of it, to see how you need to apply those safeguards. If you read the new code, you will find it more clearer, more understandable. It's easier to read and easier to use and apply. So I went through that whole code, and I must say it is more understandable. It is easier to read. So it is going to make our life easier in that way, but still it is a lot of information. It is a lot of information, things that you need to know about. And now we need to be very specific. This is not going to be a guessing exercise or, oh yeah, you know what, I can remember from my varsity days. I remember something like that. Unfortunately, you will have to put this code next to you. And every time that you're faced with a threat, you need to go and have a look at that specific section, and you need to find in the code what is the safeguard to apply for that specific threat. So what are the changes? We said there's structural and drafting enhancements, increase the clarity of the language, make it better to read and understand, simpler and shorter sentences, I can vouch for that, simplifying complex grammar, and just overall making it easier to read and understand. The big thing, the big change is sitting here. Revisions to safeguards in the code. So what the big difference is between the old code and the new code is, in the old code, it gives us a wide range of safeguards. It said, for example, safeguards could be found in the code, it could be found in practice, it could be found in your firm's established policies. There's a whole lot of different things, but very vague things that they gave us of what we can use as safeguards. In the new code, they tell us exactly what safeguard we can apply. So they give us a threat and they say, here's the safeguards that you can apply. And that's it. So like I said, you can't guess. You have to go and find the safeguard in the code. Then there's a lot of revisions to Part C of the extant code. That is the part that deals with accountants in public practice. So that is what we're going to talk about today. Lots of changes here that we need to be aware of, and new application material relating to professional skepticism and professional judgment. In the old code, they just said that you need to apply your professional judgment to determine, for example, what safeguard to apply. In this code, they are telling us what is the meaning of professional skepticism and what is the meaning of professional judgment. How should you apply professional judgment? Not only when you're using this code, but also when you are working with international standards on auditing. Because in the standards of auditing, there's a few times that the standard says apply your professional judgment. Use your professional judgment to decide on something. So I'm just going to explain these two principles to you, because now we also find the definitions of these in this code of conduct. So let's have a look at the sections in the new code. Like I said, forget about the old one. You will not be able to match and patch the old code with the new code. There's 4 parts to this, basically. The first part deals with complying with the code itself, the fundamental principles, and the conceptual framework. Now, the fundamental principles is the things like your integrity, objectivity, due care and competence, confidentiality, and professional behavior. Your conceptual framework is a 3-step process that you need to follow. So that is all in part 1. In part 2, they deal with professional accountants in business. So this is your business accountants, your accountants in commerce. Today, I'm not going to look at part 2. I'm only going to focus on part 3 again. So I'm going to focus on part 1 and part 3. Part 3 is about professional accountants in public practice. That is you. But then there's 2 more for you in public practice if you are performing assurance engagements. There's part 4A that deals with independence for audit and review engagements. And then there's part 4B that deals with independence for assurance engagement other than audit and review engagements. So that is, for example, your attorney's trust accounts and your body corps and your estate agents audits, all those other audits that you do. Part 4A deals with your normal audits plus your public interest entity audits that you're going to deal with. But remember, also here, please just remember Companies Act independence requirements. Today, I'm not going to talk about the Companies Act independent requirements. We don't have time for that. But if you start looking at the independence requirements, you also need to look at what does the Companies Act say? Because the Companies Act basically goes with this part here. So 4A, audit, review engagements, your normal voluntary audits, your public interest entity audits, all your statutory audits will be covered by the Companies Act. What are the effective dates? So part 1 and part 2 and part 3. So this is what we're going to discuss today. Part 1, the fundamental principles, and part 3 for you in practice from the 15th of June 2019. So on this date, you need to be ready. You need to start implementing. Part 4A is for periods beginning on or after the 15th of June 2019. So if you do audit engagements, this will apply for the start of that audit engagement after 15 June. Periods beginning on or after 15 June. 4B also, periods beginning on or after 15 June. But early adoption is permitted. Now, my view on this is that you are going to redo your ethics manuals and your policies and procedures. It should be ready on the 15th of June. So you might as well just implement everything at the same time. All right, so I think that most people are just going to start implementing everything because otherwise you're going to sit with two codes and you have to keep track of two codes, which I don't think is going to be a suitable solution because you're just going to confuse everybody with that. But it's up to you to decide how you want to implement. You've got the implementation dates, so now you can decide how you want to deal with it in your practice. What is the purpose of the new code? To establish the standard of behavior expected of a professional accountant. All accountants should behave in the same way and same manner. It doesn't matter what your background is, where you come from, what nationality you are, what cultural beliefs you've got. You should do the same thing as an accountant. And that is what we're going to try and achieve with this code, is to make sure that all accountants follow the same principles, follow the same rules. And obviously also if you are doing audit work, the most important work in an audit is to be independent. All right, and therefore we're all going to look at the same independent standards so that we all do the same things. The same rule applies to everybody across the board, no exception. The whole layout of the code has changed. If you can just imagine looking at an international standards on auditing standard. So if you look at an audit standard that we got used to over the years, those audit standards had introductions paragraphs, requirement paragraphs, and application material. And that is what they've done with the new code as well. So you've got your introduction that will tell you more about the subject matter. It also includes some definitions, etc. Then you've got requirements. Now the requirements are the obligations. The requirement says you shall do the following. And that's why I see a lot of rules. Requirements, rules. It's exactly the same thing. You shall do it. And then we're looking at application material that gives you some explanations or suggestions, and this will assist you to create your policies and procedures. So what you've been seeing in the National Standards of Auditing, and you got used to that, you will now also see in this code: introduction, requirements, and application material. So it is totally different than the old code. So for requirements, it will indicate an R next to a paragraph, and every R paragraph will have a shall in it, so you shall do it, not negotiable. It could have a may and a might. Very, very seldom that you see this. So you may or you might, but most often you shall. I haven't seen a lot of mays and mights in the code. You can go through it, and if you're not 100% sure if it's a shall or a may and a might, just read up on the code again. But as I say, most of these paragraphs say you shall do it. And then the application material is designated with the letter A. So that's our A paragraphs, as we call it. So what is important here? It says that accountants must comply with the fundamental principles like before. That is exactly the same. And you apply the conceptual framework. So unless there's a rule, requirement, you will apply the conceptual framework. Remember, the conceptual framework is a 3-step process that you're going to apply. So it's either the rule or the conceptual framework. It requires professional judgment. I'm going to talk about professional judgment later on, so I don't want to spend too much time on this now. Professional judgment, when it comes in, for example, when you got your rules, so there's a threat. So let's say you've got a threat. The code says you can apply the following safeguards, 1, 2, or 3. The code now says use your professional judgment to see which one of the 3 will work the best in your firm. Is it 1, 2, or 3? You don't have to do all 3, but pick one. So use your judgment to pick one. So you can see that judgment doesn't mean make up your own story. You can't just go and say, okay, let me think what will work in my firm. No, you can use your judgment to pick one of the 3 that is indicated in the code. That is what professional judgment means. The codes and the standards will never leave you on your own. It will always give you some guidance You need to work on the principles or the guidance given in the code. It's also talking about a reasonable and informed third-party test. In most of these cases, when you work with the conceptual framework, that three-step process, and when you need to apply your professional judgment, you also need to consider, what would Rip say? I call this person Rip. This is the person that is going to rip you apart if you get it wrong. This is the person looking at the situation from the outside, standing on the outside and thinking, I don't think what you've done looks good in the public eye. I would not have done it the same way. So when you apply your judgment or you apply this conceptual framework, always think, what would Rip say? The best way to explain it is put yourself in the shoes of Rip. So let's say you were the person looking at it from the outside. What would you say about that situation? Now, I'm sure you all listened to the news this morning about the auditor that was threatened to make some payments. Again, the auditor is now on the stand testifying, said he was threatened, did some things that probably is not going to go down well in our profession. So if he just sat there and said to himself, how would this look if I'm Rip and I'm looking at this from the outside? What would I say about it? What does every auditor and accountant that looked at the news this morning thought about the situation? You were all Rips this morning when you listened to the news. You all have an opinion on this now. What would you have done in that situation? So it's easy to look at it from the outside and say, what is the right thing to do? And when you're in that situation in the moment. But what the code says is take yourself out of that situation. Ask yourself, if I'm Rip, what would I say about the situation? And you will have your answer, what is the right thing to do? The code also says, when threats are not an acceptable level, apply your safeguards. So every time you need to go and see what is an acceptable level, I don't know, how do we find out what is an acceptable level? Well, what would Rip say? That is what the code says. What would Rip say? If Rip say, no, it's not at an acceptable level, apply your safeguard immediately. Right, so that's basically what we're going to talk about today, is how to apply this framework, how to use your professional judgment. What would Rip say? And if Rip would not be happy, apply your safeguards. Compliance with this code. We know that we need to act in the public interest and not to exclusively satisfy the need of an individual audit client. So if we are pressured by one client, we should not buckle under that pressure. And go back to the news this morning. We should not buckle under the pressure. If we get threatened, we shouldn't just think about that one client that's threatening us. We should think about what's best in the public interest. The code also says that if there is a law or regulation that precludes you from doing something, now we need to think about this. Which one will prevail? Is it the act or is it the code? Now please just remember that an act is always above a code. For example, the Financial Intelligence Center Act is an act where you need to make certain reports. You need to do certain things. Here we can also think about things like confidentiality, etc. Which one will override the other one? The act was always above the code. So please, if you're not sure what to do, look if there's an act. The act will override what is in the code. If you have to report, you have to report. You cannot use the code as an excuse to say, oh, but this was confidential and I'm not allowed to disclose it because our code says I can't disclose it. But there's an act that says you shall disclose it. The act is above the code at all times. Also, the question that is often asked is, what about trainee accountants? Do they also fall under the same umbrella? If they do something wrong, who's going to be in trouble. And I just want to go through this with you quickly if there are any trainees listening today. Improper conduct on the part of a trainee accountant shall include any conduct that would be improper had it been perpetrated by a member or associate. So the same rules apply to trainee accountants as well. The SAICA training regulations require that trainee accountants should always keep the affairs of the training office and its clients confidential, not breach any code of professional conduct. So this whole code applies to a trainee as well. The disciplinary rules or the bylaws that apply to the CASA or the AGA-SA or the registered auditor. So trainee accountants, listen carefully. This code applies to you as well. Every single part of this applies to you as if it would apply to your partners. So I'm going to move on now with the compliance with the fundamental principles. But before I do that, I just want to quickly show you a few things. The first thing that you need to do now is you need to make sure that you update your manuals. Now, the manuals that you've had, the old ones, as I said, get rid of them immediately. Don't even try to patch them. You're going to have to start all over with the new manuals. Now, if I just want to show you, most of you has got this manual that you're going to have to update now, and I just want to quickly take you through this. So the manual consists of, you need to combine your quality control and your ethics because they go hand in hand. Oh, well, that is what we did, is to combine the two. So the first part of the manual consists of your quality control policies and procedures in terms of ISQC 1. The rest of the manual then deals with our independence requirements and our ethical requirements. What we did in this manual is from part 9, we broke it down into complying with the Code of Ethics, all the fundamental principles that I'm going to talk about now, with their policies already designed. So all you need to do is you just need to go and select the policies, or think about the policies that you're going to apply in your firm, tailor it for your firm. Independence requirements for audit and review engagement other than public interest entities. So we split out your normal voluntary audits and your public interest entity audits. So your normal audit work, other audit work except for public interest entities and statutory audits, you split out, and they've got their own requirements, independence requirements. And that is also what I'm going to take you through today. So I'm going to look at the normal audit independence requirements, and I'm going to look at your public interest entity independence requirements. Then there's independence requirements for audits that requires statutory audits in terms of the Companies Act. Remember, I said that you must never forget about the Companies Act. Today, I'm not going to talk about this because we will not have time to go through this part here. Then we've also got separate independence requirements for independent reviews. This is a statutory independence requirement that you also find in the Companies Act. We're also not going to look at that today, but don't forget about that. Then we've got our independence requirements for clients that are public interest entities. So I'm going to take you through that as that one today. And then we've got responding to non-compliance with laws and regulations. That is your no-CLAR sections in the code. And there's also reportable irregularities, which I did bring into the presentation, but I'm not going to talk about it. I'm just going to skip through those steps. And then there's tax practice. So there's quite a few things under tax practice that you also need to be aware of, ethical stuff there, but I'm not going to talk about the tax practice issues today. All right, so all in all, I'm just going to cover your fundamental principles. I'm going to look at compliance with the code. I'm going to look at independence for your normal audit engagements, other than public interest entities, and no-CLAR. So that is what I'm going to talk about today. So that is what you will find in your Code of Ethics. Just to come back to the first part here, just to give you a indication of what is going to happen now. The Code of Ethics part, you have to update now before the 15th of June. You need to have your manual in place before the 15th of June, all your policies and procedures sorted out. But they are currently working on quality control part of it as well, the ISQC1 as we know it. So that is going to change to ISQ M1 and ISQ M2. So there's two new quality control standards, and they've also made changes to ISA 220. Those are still in draft format. They have not been released yet. So we did not update the first part of this manual, only the second part of the manual. We expect them to release those ISQMs this year still. So I'm just warning you, although there's nothing that we can do about it now, that this will change again, maybe later this year, or I believe maybe in a year or so, when that becomes applicable. You also have to update the first part of the manual again. But for now, you leave it as ISQC1 and ISA 220. Those policies and procedures will stay exactly the same. And for now, it's only your Code of Conduct policies and procedures that you have to update. All right, so this is the part that I'm going to discuss now, is compliance with the fundamental principles. The fundamental principles stays exactly the same. There's just a few things that I'm going to highlight. I'm not going to spend too much time on everything because, I mean, this is old news, all right? I'm going to focus on the areas that I really think you should take note of, where people get themselves into trouble, so that at least we just make sure that we got our policies and procedures sorted out for that. So we still got our five. There's 5 fundamental principles. The first one is integrity. Integrity means to be straightforward and honest in all your professional and business relationships, fair dealing and truthfulness. Now this part here is the important part. Not knowingly, very important, not knowingly be associated with reports, returns, communication or other information where the information contains a false or misleading statement, contains statements of information furnished recklessly, omits or obscures information required to be included where such omission or obscurity would be misleading. So you may not knowingly sign any report, document that you know is false or misleading. For example, a client comes to you and say, I need a document for the bank to confirm my income. My income is 1 million a month. Please will you give me this document? Without doing any work, the practitioner puts his signature on that document, knowingly that I don't think this is close to the truth even. So you're not allowed to do things like that. This is similar to what we've got in Section 29 of the Companies Act. Section 29 of the Companies Act says that any person who is involved in the preparation of financial statements that is materially false or misleading or incomplete is guilty of a criminal offense. So there we've got a criminal offense. So if you're not doing financial statements, but you do any other work, any other report, maybe a tax return, communication, the same principle apply as Section 29 in the Companies Act. You may not get involved. Now the code says you must take, remember this is an R, this is an R. You must take the necessary steps to be disassociated from such information. You may not get involved and deemed not to be in breach if it's a modified report. So if you're preparing financial statements and you issue a qualified report, then you're still fine. So then you will not be in breach of this Section 29 and this Code of Conduct. Right, so you can see the R there where I show you, I also included the reference number in this presentation to show you where is your R's. You can see that one also an R, and there's your application paragraphs. The other thing that I must just mention to you is that we've got 3 codes at this stage. We've got the international code that applies to all accountants. Then we've got the IRBA code and we've got the SAICA code. IRBA code is based on the international code and they made some changes to the international code. They added some more paragraphs. Remember, they cannot take away. They added paragraphs, more stricter requirements than in the international code. SAICA also adopted the international code and they also added some paragraphs. Now, I have highlighted the paragraphs that IRBA and SAICA added in red in this presentation, but I've also added some other things in red later on, so I'm just going to indicate to you when is it an IRBA requirement and when is it just something that I just thought you really need to know about it. I just had to highlight that as well. But please, in the codes, they will underline it or they make it bold in the codes. But the code that you need to look at if you are doing audits, you're an IRBA member, in your assurance engagements, you look at this code here, the IRBA code. All right. They all work the same. And where in the code, when you read the IRBA code and the SAICA code, any additional paragraphs, they've indicated with an SA, South Africa, in that paragraph. So you can see immediately where are the additional paragraphs because they indicated with a SA abbreviation there. Now, you also need to look at the improper conduct. IRBA also releases a document, what is improper conduct. So you need to read this together with your code. Now, I also just want to take you through what does IRBA says, what is improper conduct for an auditor. You always need to read it with the code. It says, if a person has been found guilty of dishonesty, in particular theft, fraud, forgery, or uttering a forged document, bribery, or corruption, is dishonest in providing any professional service, or if an auditor was put in a position of trust, any dishonesty is improper conduct. And then also with the intent to evade or to assist another person to evade tax. Knowingly or recklessly prepares or make or assist in any person to prepare or make any false statement, signs any false statement, or prepares or maintains any false books. So this is what we've got as IRBA's, what they regard as improper conduct. So please remember you read the code plus what does IRBA say is improper conduct. Any dishonesty, any assistance to any person to evade tax, sign false statements, make false statements, assist a person or prepare or maintain any false books or accounts or other records. Objectivity. Objectivity is going hand in hand with independence. We need to be always objective. You can only be objective if you're independent. And that is why we are going to look at all the independence requirements today. Professional competence and due care. You cannot provide services if you don't have the competencies to do it. You need to maintain your professional knowledge and skills. Therefore, you need to do your CPD. I see that SAICA is now busy with a program where the CPD and what you're going to maintain your professional knowledge, you train, retrain, forget about what you learned, retrain again. They're going to change the whole concept of what is CPD, how you need to do your CPD. So I believe things are going to become very, very strict, a lot different than before when they released their document. And I think they said it's now going to be in 2019 somewhere, in the beginning of the 2020 year, you're going to see a big change in maintaining professional knowledge and what they will require of CAs going forward. They do say that if those are working under a professional capacity, those working like your trainees, appropriate training and supervision, it's a requirement, very, very important. Make the clients or users of your services aware of any limitations. That's also a requirement. If you don't know how to do something, be honest, find help, consult, but don't take on any work if you do not have the competency in the firm to do it. Remember, one of the 7 declarations when it comes to ethics on audit files is that you shall say collectively, myself and my team, myself as the partner and my team have the necessary skills and the knowledge and the competencies to perform this engagement. If you can't say honestly on working paper, collectively, do not take on that engagement. Now you can see here, there's a South African paragraph. This is what I was trying to tell you. Here's a South African paragraph. So this applies to IRBA members. This is from the IRBA code. May not undertake or continue with any engagements which we are not competent to perform unless we obtain advice and assistance which enables us to carry out the engagement satisfactorily. All right, so please take note of the South African paragraphs. I make it clear that if you do not have the competencies in your firm, do not take on that engagement unless you can get advice or assistance. Improper conduct here. Remember, this is now from the IRBA improper conduct list. Fails to perform any professional service or duty with such a degree of professional competence, due care and skill as in the opinion of the regulatory board IRBA may reasonably be expected, or fails to perform the professional services or duties at all. So that is what they say, improper conduct. Confidentiality. Not to disclose certain information to a third party unless you've got the consent of the client. So the general rule is that you may not talk, you may not discuss, you may not hand out information to a third party unless you've do it with the client's permission, but there are some exceptions. The few exceptions that we do have here is if you have to produce your documents in terms of legal proceedings. So if you get summoned, you need to go to court and they want to see those files. Disclosures of reportable irregularities reported to IRBA. This is in terms of an act. So please remember, this overrides the code. This is then section 45 in your Auditing's Profession Act that says you shall disclose reportable irregularities to IRBA. That is where I said that the act will override the code. If it's permitted by law and it's authorized by the client, I just need you to note the difference here. If you disclose your reportable irregularities to IRBA, you don't need the client's permission to do it. Anything else, any other thing permitted by law, unless the law precludes, unless the law says you may not tell the client. But for example, in FICA is also one of those acts, then you need to have it authorized by the client. Professional duty or right to disclose when not prohibited by law. The quality control review of IRBA. Now, IRBA might come in and do your quality control reviews. They come in and they do your inspections. You cannot say to them, I don't want to provide the files because it's confidential. You have to submit those files to them, but also you need to get the, or not the permission, but keep the client informed about it. So somewhere in your engagement letters, you need to say to a client, we are subject to inspections by the regulatory board and we will be obliged to hand over your files or files. Your file might be one that they pick, and we just want to inform you that by law we have to give them your files. So just make sure that your client are aware of it, and a good place to put it is maybe in the engagement letter. Inquiry or investigation by a professional regulatory body. We saw this the last couple of months. They will ask for information there when they want to do an investigation. And again, you can't refuse to provide that information. The very important one here is NOCLAR. Just want to quickly discuss NOCLAR here. NOCLAR is in terms of the code. It's not an act, it's in terms of the code. But NOCLAR overrides all confidentiality agreements, which means that if you come to a point, if you follow the process and you come to a point and you need to disclose because it's in the public interest to disclose, then the code says under NOCLAR, you don't have to worry about confidentiality. So confidentiality NOCLAR overrides confidentiality. All right, so just remember that one as well. How long must you keep everything confidential? Even after the end of the relationship? That's always. I mean, it doesn't mean you end the relationship and now you go and disclose everything to competitors, etc. You can use prior experience that you've obtained from other clients. You can use previous experience and your knowledge that you've obtained, but you shall not use or disclose any confidential information acquired or received as a result of professional business relationships. Professional behavior, not to discredit the profession. Here they also talk about a reasonable and informed third party. So whatever you do, when it comes to professional behavior, if you think, do I now act in a professional manner? I'm not so sure. Think about RIP. Put yourselves in the shoes of RIP. What would RIP say? Then marketing or promotional activities, don't exaggerate claims for services. You cannot say, I am better than the accountant next door. Come to me. I provide a better service. I can help you save tax where he cannot do it. We are not allowed to say things like that. And also don't compare your work with the next accountant. So don't say I see that this person prepared the financials. It is very, very poor standard of work. If you think it, but don't say it. Never say it out loud. Not to anybody. These things have a tendency to come back and bite us. We're not going to compare our work with anybody else's. Think what you want to think, but please never ever speak it out aloud. What is improper conduct here? You may not let your name be used in connection with an estimate or earnings contingent upon future transactions in a manner which may lead to belief that the register auditor vouches for the accuracy of the estimate. You cannot let people abuse your name and say, I'm starting this scheme and my auditor vouched for it. Call my auditor. They will tell you it's such a good scheme. It is such a good plan. You may not do things like that. And if you find that clients are abusing you or using your name, you need to take steps to distance yourself from that client. So if there's any rumors where they say, go and talk to my client, my auditor, they can vouch for it, you need to distance yourself from that client. Another improper conduct, and this one happens quite often, fails to answer or deal with it appropriately within a reasonable time any correspondence or any other communication from IRBA, the regulatory board, or any other person which reasonably requires a reply or other response. Sometimes it does happen that IRBA sends you, if I say you, I don't mean you specifically, I mean a professional person, a letter, a communication, wants them to respond. Sometimes we forget, sometimes intentionally we're scared, we don't want to talk to them, we think they will go away. But they say this is improper conduct. If a client asks you for information, within a reasonable time period, you need to respond. How difficult it is, yes, it is difficult sometimes. Sometimes we would just hope the thing will go away, but I promise you it will not. If that client turn around and go to IRBA and say, I have now asked my auditor 10 times for this, he's not responding to me, IRBA regards this as improper conduct, so please be very careful. Doesn't matter how hard the situation is for you, please just respond to your client or to IRBA in a reasonable time. This is also something that quite often happens. Client says, please, I don't want you to audit anymore. You failed to resign from the professional appointed when requested by the client, and then failed to transfer all books and papers that are the property of the client. You're not allowed to hold on to those papers and books and everything that belongs to the client, not even if they owe you money. Please, I've seen this happening a lot in the past. Client owes you money. Practitioner says, I will only give you the books if you pay my fee. Unfortunately, you're not allowed to do that. IRBA does see it as improper conduct. All right, so that was the fundamental principles combined with improper conduct. Now I'm going to talk about the compliance with the conceptual framework. Remember, we talked about the three-step process. This is the three-step process that we're going to follow. So what are you going to do? You're going to identify threats to compliance with the fundamental principles. You're going to evaluate the significance of the threat, and then you're going to apply safeguards to eliminate the threats or to reduce them to an acceptable level. Again, they say here, when you apply this conceptual framework, Exercise professional judgment, remain alert for new information, and use the RIP test. So those two I want to highlight, those two. How do you use the conceptual framework? You apply your professional judgment based on the information in the code. Please, I will come back to this again later. You cannot just go and make your own decisions. You cannot make up your own stories. Whatever judgment you apply, use the code for that. Stand back and think, what would RIP say about it? Is this the right thing? What will RIP agree with me or not? Now, here's professional judgment. Now, let's just talk about professional judgment, because in audits, for example, auditors are often getting themselves into trouble when it comes to professional judgment, because they say, a reviewer comes in and say, well, how did you get to testing 25 items? How did you decide to test 25 items? And the practitioner will sit back and say, I used my professional judgment. I decided that 25. The standards say I can use my professional judgment. I can decide. So I decided 25. And then they get very upset when IRBA comes and say, sorry, but we're going to give you a finding. But why? I use my professional judgment. How can you say my judgment is not good enough? Now, this is where the problem comes in. Remember, the auditing standards and this code will never leave the auditor on its own to make a decision. So, yes, what is professional judgment? Professional judgment means decide. You're going to decide on something. All right, otherwise it will have told you, it will tell you, do this, do that, do this. But it doesn't. It says decide. But you need to remember now that before you've got professional judgment, there's a principle. So whether you use the international standards on auditing or you use this code, before professional judgment, there's always a principle or a requirement, a rule, or a list of safeguards. Now, this is what I'm going to talk about today, is this list of safeguards here. So, if you are applying this code and it says use your professional judgment, you need to go to the list of safeguards in the code. If you're using international standards on auditing, you're going to go back to this standard and see what is the principle explained in the standard. So for this 25 items, if this was a test of control that you had to determine the number of items, then the standard on sampling says, think about how much assurance do you want to place on that test? How much assurance do you want to obtain? How much is the reliance that you want to place on that control? If it's high assurance that you want to get, you need to test more. So it's all about assurance that you want to obtain. That's the principle. Assurance is the principle. If this was a sampling with a sampling method where you need to select, let's say, debtors, values, says how many debtors should I test? It's not a test of control, it's a substantive test. Then the standard says the principle is risk. The higher the risk, the more you need to test. The lower the risk, the fewer items you can test. So it's either a principle or it's a list of safeguards, usually, that you need to think about. But it's never your own decision. Never, ever. If you sit there and you think, I think that this would be a good idea, you're on the wrong track, you're thinking wrong. Please, you may not do that. So I hope this explains professional judgment, because it's a new concept that I brought into. It's not new, but they've now just clarified it for us. This is how you should deal with it in the code and in audits. Identify and evaluate threats to compliance with the fundamental principles. Now, we've got 5 fundamental principles and we've got 5 threats. Now, the first threat here is a self-interest threat. You're all familiar with this. Again, I'm not going to spend too much time going through all the threats. I'm just going to quickly highlight a few things that I think is really, really important, and that also that I know that they focus on. We know about a direct financial interest in a client. You may not have that, because that, if you have shares in a client and you audit that client, there's a self-interest threat. Quoting a low fee. This is becoming a very, very big problem. We're all under pressure to get work. People are cutting throats wherever they can. They undercut our fees. We're trying to keep up just to get clients, and sometimes we quote a fee that is so low that we will not maintain our professional standards. Now, IRBA is checking up on this. For example, if you are doing work on an estate, on an attorney's trust account, and you send your fee note into the Law Society for a refund, or the client does it, remember the client that pays your fee is going to send your fee note in to claim that fee back from them. If they find that the fee is so low, they think that the fee that you charged is too low for the amount of work that you had to do on that attorney's trust account, they're going to inform IRBA. And IRBA will do an investigation. So they are looking at the fees that you quote now, the fees that you charge for a specific engagement. Is it enough to warrant the amount of work that you need to do? Now, I know what we're thinking is that if I have to charge my full fee, then somebody next door is going to take my work. Well, if it comes to audits and those kind of things, then that somebody else must also charge a reasonable fee. So let them rather than be in trouble for charging that low fee. It's not worth it at the end of the day, because all auditors will now be treated exactly the same. If IRBA goes in and they do an inspection and they find that the other person charged a very low fee for the amount of work that is necessary, then obviously they're going to apply penalties to that person. So it's really not worth our while to take a chance there. Think about the fees that you're quoting. Is it enough to warrant the amount of work that you need to do? Close business relationships with the client. We're going to talk about that later. Obtaining and access to confidential information for personal gain. And discovering a significant error when evaluating the results of a previous professional service performed by a member or a firm. All right, so just examples here. We're going to look at the specific threats. There's a long list of threats that are mentioned in the code, plus each one of those threats safeguards. Self-review threats, this is the big one. You cannot perform an audit work on work that you've done yourself. So, for example, and I know I'm going to rock the boat here today again. I always do that. You cannot prepare financials and do the audit on the same set of financial statements. What we do often see in practice is we get the half-back trial balance from the client. So they don't know how to pass the journals like depreciation and finance charges and tax and all of those things. Then we take the financial statements, and while we do the audit, we pass the journal entries. So we're actually preparing the financials while we do the audit. That is what we are talking about. Later on, you're going to see the exact wording in the code that prohibits this completely. In the new code, you're not allowed to do that. So what you need to do is to make sure that you got one person or one group in the firm to prepare, hand it over then to the audit department. Otherwise, there is another safeguard that you need to apply, and that other safeguard is going to be the more expensive one. We'll talk about this later again, but please, that story where we get a half-back trial balance from a client, prepare the financials while we do the audit, that is a serious self-review threat. IRBA is checking up on this. And also there's many reasons in the standards of auditing why you also should not start with a half-back trial balance, where you should start with a complete set of financials when you do your audit. But I'm not going to go into those details today. Right. Advocacy threats, just quickly. Promoting a position or an opinion to the point that subsequent objectivity may be compromised. For example, promoting the interests of shares in a client. You cannot promote shares in a client. You cannot tell people to go and buy shares in a client or invest in a client. Acting as an advocate on behalf of a client in litigation or disputes with third parties, or lobbying in favor of legislation on behalf of a client. So this one, you cannot act as an advocate on behalf of the client. If you, for example, assisted the client with a tax matter, a tax scheme, and they implement it and there's problems later on and they get problems with SARS and this whole thing goes to court, you cannot be objective if you're the person that needs to go and fight for the client. because you assisted with that scheme. You practically implemented or assisted them with implementation of that scheme, or told them to do it, or helped them to do it, or however you want to see it. How can you be objective afterwards? And that is just what they're trying to tell us here. Familiarity threats, close or immediate family member who's a director or an officer of the client, a director or an officer of the client that recently served as an engagement partner, that is a serious threat, and an audit team member having a long association with the audit client. Please make a note. This is a new thing in the code. Long association with an audit client. This is all new stuff that we're going to look at later on. Then your intimidation threats, threatened with dismissal from a client because of a disagreement about a professional matter, pressure to agree with the judgment of a client because you think they've got more experience than you. A planned promotion will not occur unless you agree with an accounting treatment, and accepting a significant gift from a client. Now, please make a note, this is also new. The heading is accepting inducements from a client. Right, this is also new, a whole new section in the code that we're going to talk about. Again, if I listen to the news this morning, this auditor says that he was threatened. Even if he's threatened, then walk away. But you can't do things because you are threatened. Not in our life, not in our code, not in our profession. So please just take note of that. You can't now have that as a reason why you did certain things is because you got threatened. It is a threat. You need to deal with that threat. So how are we going to evaluate those threats? You need to see if the threat is at an acceptable level. How do you do that? Look at RIP. What would RIP say? Okay, what would RIP say? Who is this RIP? Does not need to be an accountant, but should possess the relevant knowledge and experience to understand and evaluate the appropriateness of conclusions in an impartial manner. So RIP doesn't need to be another accountant. Anybody in the public, anybody that listened to the news this morning is a RIP. Okay, that understands a little bit of our profession and can see that what happened is wrong. Okay, so you're going to see if it's an acceptable level. When you document in your file where you say, I think this is an acceptable level, don't use I. It's not you. It's RIP. Say, what would RIP say? You come to the conclusion that RIP would agree with you. Never use the word I in your conclusions, in your documentation. Use the word RIP. Well, not RIPed. Reasonable informed third party. So how can you eliminate or address these threats? This is what the code says. Eliminate the circumstances. So sell the shares, end the relationship, apply safeguards, or decline or end. Now, there is sometimes when they're going to say to you, apply your safeguards. This is most often you're going to have safeguards that you can apply. But there are certain instances in the code where they say, well, nothing that you do can eliminate those threats or reduce them to an acceptable level. So you need to decline or you need to end the relationship. And that is why I say you need to know your code. Because maybe the code says decline or end and you apply a safeguard. This is serious trouble. So please, we need to go, you can see it's a R, decline or end. If the code says decline or end, you must decline or end. You can't go and apply a safeguard. All right. So coming back to the fact that you really need to know this code by heart. Implementing safeguards. In the old code, they said that safeguards is a wide range of things. It could be established by the industry, by the practice itself in terms of policies and procedures, by educational matters like what you've learned in adversity. They gave us a whole wide things of like, I want to call it more airy-fairy things, not specific things that you could do. Now they become very specific, very, very specific. All right, and they say, here's examples of safeguards. All that airy-fairy stuff is gone. Assign additional time and qualified personnel to required tasks when an engagement has been accepted. Make sure that your staff members is competent enough to perform the engagement. If you know that you're going to do a higher risk engagement, appoint more qualified senior staff members to that engagement. You will also remember that from your ISA, your International Standards on Auditing, if you've got an overall risk an overall significant risk, the standard says you need to provide an overall response. Now, an overall response, there's three things. Number one, more senior staff. Number two, more supervision. And number three, surprise element. Now, this is exactly the same. If you've got a threat here and you know there's going to be a big threat and you want to bring it down, assign competent staff, more experienced staff, people with the necessary knowledge to deal with that matter, okay? This one here comes up every time. Have an appropriate reviewer. We'll talk about this one quite often. Most of the time they say, if you can't apply one of the other safeguards, then your only other alternative is going to be to appoint a reviewer. So this is another person that's got no involvement at all in the engagement will come in and review that file. But just remember that if you're going to go for this option, if the other options is not going to work for you and you're going to go for this option, this is the more expensive one, because this is where you're going to need another accounting professional, like another CA to come in or RA to come in and review your audit file. So watch out for this one here. Different partners and engagement teams to provide non-assurance services. The non-assurance services needs to be split out in your firm. The non-assurance services needs to be performed by partners and engagement teams who is not involved in an audit client. And I come back to that whole story about non-assurance services means preparation of financial statements is a non-assurance service. And here again, it says the only thing that you can do is to split your practice into different parts, have different partners, have different engagement teams to prepare the financials, and then have a different team to do the audit engagement. Or involve another firm to perform or re-perform part of the engagement so that they can take responsibility for that part and not your firm. We see this in the statutory audits, where another firm needs to prepare and your firm needs to do the audit. Disclose to clients any referral fees or commission arrangements. We'll get to that. And separate teams when dealing with matters of a confidential nature. There's specific rules here when it comes to how to split out those teams. Again, use the RIP test. So this is what I'm trying to say. Here is basically, this comes up every time as a safeguard that you can pick and choose from. Pick and choose from this, what you're going to do, but make sure that RIP is also happy with your selection. Use your professional judgment to pick one of these and make sure that RIP is happy. That is what we're going to do all the way throughout. And this is what the code is telling us. Now we're just going to look at some specific aspects to the code. We're going to look at resolving a conflict of interest. Now, a conflict of interest is where, let's say you have two clients in the same industry. They are either competitors of each other and you audit both of them. Now you've got a conflict of interest. The code is very, very specific. You may not do both audits unless you've got certain safeguards in place. Please just take note of this. You may not perform the audits if you do not have certain safeguards in place. So you need to carefully look at your clients and see where do you have conflicts of interest. There's a whole list of examples in the code. I also did bring it into the manual for you so that you can know exactly when do you have a conflict of interest and when do you need to apply. I often have clients where they say to me, Lenny, I have these clients in the same industry, but I never did something in terms of the code. Am I going to be in trouble? Well, I don't know, but if the proper hits the fan, they're going to ask you, but why didn't you tell us? Why didn't you tell us you're also auditing XYZ and they're in the same industry and they're competitive as? If you told us, we would have told you that we will not use you as the auditor anymore. So why didn't you tell us? We're going to tell IRBA that you didn't tell us about it. So be careful of this. It says that you need to implement measures to prevent unauthorized disclosure of confidential information. So create separate practice areas. This is what you can do. Limit access to client files. Sign confidentiality agreements by the staff members. Separate the confidential information physically or electronically and provide specific and dedicated training and communication. So you need to do these things. This is your policies. What are you going to do? So you're going to say, well, we have separate engagement teams or separate areas of practice that deals with this. If that is your measure that you're implementing, that's your policy, That is it. That's fine. Just have a policy on this and do what you say in your policy. But here's the safeguards. Separate engagement teams or an appropriate reviewer. Now, if you do the audit of two competitors, you either need to make sure that you've got two separate teams. One team do the audit of the one, the other team do the audit of the other one. And if that is not possible, if you only have one team, unfortunately, you need to bring in an appropriate reviewer. Can you see the effect of this code? You need to do either this or this. That is it. That is what the code says you shall do. Then you must also, when required, disclose the nature and the conflict to the client and obtain consent from the client to perform the professional service. So you go to client A, you go to client B, and you say, I've got a conflict of interest. I need your consent so that I can continue with the engagement. When disclosure or consent is not provided in writing, you need to document in your file the nature and the circumstances giving rise to the conflict of interest and the safeguards that you applied. So if you don't get the consent, you need to document all of this in your files and what safeguard did you apply. But if the client refuses to give you consent, so B says to you, I'm not going to let you do the audit if you're still the auditor of A. They refuse to give you consent. Here is my example. End or decline to perform the service or end the relevant relationship. Ladies and gentlemen, that is it. This is or it says you shall decline. If you don't get the consent of the client, you shall decline that engagement. That is it. So you can see it's very, very limited now and for me it's rules. That's why I say, for me it's rules. That's why we need to understand these rules. Professional appointment. Watch out for clients in illegal activities, dishonesty, and showing unethical behavior. Just a quick summary of this. If you do an audit, for example, and you've got problems with the integrity of the client, the standard says you need to look at integrity. You can still continue with the engagement. You can say, yeah, I've got a problem with integrity. They're the most honest people on earth. I've got a little bit of a problem with integrity, but I'm going to continue with the engagement. And you can say yes, and you're going to raise your risk. You're going to have a high risk client because of this integrity, which means that your overall response is, I am going to appoint more senior staff members. I'm going to have more supervision review, or I can do more surprise element testing, etc. Because that's what the standards allow us to do. But the code says, if your client is involved in illegal activities, your client is smuggling drugs, or your client is involved in money laundering, or your client is just completely always dishonest and unethical, the code says, walk away. We cannot get our hands dirty. You need to walk away. Also, you cannot accept the engagement if the engagement team does not have the necessary competencies. We talked about it. Word, collectively. If you can't put that on paper, don't accept the engagement. Obtain the client's permission in writing to initiate discussions with the existing accountant. Okay, we all know that you need to contact the existing accountant. Ask the existing accountant if they had any information that they are aware of that we should rather decline the engagement. If you can't talk to this existing accountant, also obtain information from other sources, such as through inquiries of third parties, background investigations regarding senior management. So either you've got that letter from the previous accountant and say, I have no reason to believe that you should not undertake this engagement. You do also a little bit of background, then you can take the client. They want to see what steps did you take. They want to see this. What steps did you take to obtain information about your client? Did you Google? Just go and Google and say, yes, I Googled. I didn't see anything. But if you Google and there's 50 reports popping up about how dishonest the client is, walk away, all right? Because they can do the same thing and see what pops up here. Okay, so why did you accept the client if this is obvious to everybody that the client involved in illegal activities or dishonest. If you're unable to communicate with the existing accountant, you must take reasonable steps to obtain information about any possible threats. Now, let's look at how to read these codes. What I've showed you here is the international code. So this is the international code. This is if you're not an IRBA member. If you're an IRBA member, look at this one here. This is South African additional items added to the code. Now, IRBA added this. A proposed client refused permission to communicate with the existing accountant. Decline the appointment unless there are exceptional circumstances. You have to decline. If you're an IRBA member and the client does not give you permission to communicate with the existing accountant, decline the appointment unless there are exceptional circumstances. You need to document those exceptional circumstances in your file, and they really need to be exceptional. Exceptional does not mean I cannot contact the existing accountant. That's not exceptional. What else can give you such a good reason that you still take that client on while the client refused that you talk to the existing accountant? Okay, so please be careful. You need to decline unless there's really, really a good reason, and you need to document that reason. If the client refused to grant the existing accountant permission, they must disclose this fact to us. Also, the same applies to you. The client, the client says that you may not contact or you may not answer the new incoming accountant. You need to disclose that fact to the other accountant and say the client refused. The client said, I cannot give you any information. So that other accountant can read between the lines. And please note, this does not apply to NOCLAR. So while we're on the topic of NOCLAR again, let's just quickly talk about it. Like confidentiality agreements or confidentiality is NOCLAR overrides confidentiality. And also you and the other accountant, or let's say you are replacing another accountant, that other accountant, if they made reports in terms of NOCLAR, so they reported the client, they have to give you that information. They have to tell you what did they report. If you are being replaced by another accountant and you are busy making a report in terms of NOCLAR, you also need to inform that incoming accountant that you are making a NOCLAR, that you are reporting the client. You cannot hide this from the accountant. So, or let's say you can't hide it from each other. Okay, so depending on which side you either need to tell the other accountant or they need to tell you that they're making a NOCLAR. So confidentiality and professional appointment are affected by NOCLAR. You will see that I am going to skip through a few slides. As I mentioned in the beginning, the reason for this is that I just want to focus on the most important things that I think you should know of. I did include everything in the code just to make sure that you got a nice checklist or a document that you can refer back to that can serve as a summary of the whole code. But I definitely don't have time to go through every single thing. So some of them I'm just quickly going to refer to a few important things. Other slides, I'm just going to skip over that. All right. Just on second opinions, just what you need to know here is that there is a threat if you don't have the same facts and information as the other accountant that gave an opinion. So there's just the safeguards that you need to apply. This is just what I want to highlight here. With the client's permission, obtain the information from the existing accountant. You can't just go to the existing accountant. You need to get the client's permission in writing to do that. Describe the limitations surrounding the opinion in communications with the client. And this one is important. Provide the existing accountant with a copy of your opinion so that you're all on the same page. All right, so just these are rules, things that you need to do. You have to follow these rules here. With fees and other types of remuneration, we did talk about it quickly. You can quote a fee that is lower than usual and that is lower than what another accountant would charge. In itself, it's not unethical. It is a problem and becomes a threat if it's so low that you can't perform all the work that you're supposed to perform. All right, so just watch out for that. And I did say that this is becoming critical. IRBA is looking at this to make sure that you charge the appropriate fees. If it does happen, you need to apply a safeguard. Again, adjust your level of fees. So either fix your fee or, and look at this, get a reviewer, another person to come and review the work. Very, very expensive option. So if you leave your fee low, in any case, you have to get this other appropriate reviewer to come and review your work. So it's, it's not really worth it to go so low that it warrants an appropriate reviewer. Contingent fees, what is in red, South African requirement there, just watch out for that. You may not charge a contingent fee for the preparation of an original or amended tax return. So if you're doing auditors, IRBA members may not charge contingency fees for preparing tax returns. In any other case, if you do charge contingency fees, you get an appropriate reviewer in, and you need the advance written agreement with the client based on remuneration. So if you're going to charge contingency fees, you need a written agreement with the client that explains everything to the client. On what basis are you going to charge those contingency fees? Referral fees or commissions, you need to get the advanced agreement up front and in writing. What is in red is the South African requirement. Please, advanced agreement up front and in writing if you're going to refer clients or receive commissions, and also to disclose to clients up front and in writing the fact that you are going to receive referral fees or commissions. So just to recap again, if you're going to receive commissions or referral fees or pay it, advance agreement upfront in writing with the client, disclose the fact to them upfront and in writing. What is in red is the South African requirements there. Custody of clients' assets. It's a whole section that came into the code not too long ago. You may not assume custody of clients' money or asset. We don't recommend that you as the auditor keep clients' money or assets, but it does happen, and sometimes you don't have a choice. You have to do it unless it's permitted by law and in accordance with any conditions under which such custody may be taken. It is a requirement. So what law allows you to keep this assets or money? If so, then there's just a lot of things that you need to do. First, you need to inquire about the source of assets. So on your working paper, you need to know exactly where does the money come from. If you find then that the money is from illegal activities, then obviously you can't hold that assets or money on behalf of the client. So very important, inquire where does the money come from, what is the source of that money. If you don't know, don't accept it. This is in red. This is again the South African requirement here. You may not accept or hold assets if derived from illegal activities, such as from money laundering, and any provisions of no CLAR apply. So if in terms of a non-compliance with laws and regulations, any unlawful activity, you may not hold those assets on behalf of a client. When you are entrusted with these money, so let's say you do take it, comply with the laws and regulations, but keep it separate from your firm's assets. You must keep it separate. Only use the asset for the purposes for which they are intended, and always be ready to account for these assets or money. So proper reconciliations, proper accounting records, etc. If you're an IRBA member, here are the rules. What I showed you on the previous screen again is the normal rules. That applies to all accountants. But if you're an IRBA member, you've got more rules. The first thing here, the most important thing, you may never, ever call it a trust account. It is misleading. You may not say, I will keep the money for you in trust. You may not even use that word. You must maintain a bank account that is registered in South Africa, that is separate from your own bank account, so it cannot go into your firm's bank account. You must appropriately designate such bank account. This includes your auditor's name and where all clients' monies are held. So you can have one account where you hold all your clients' money. So you can call it like ABC client account, your firm client account, or a specific account name and operated per relevant client. All right, so you can have one account or you can have more than one account you can open it up per relevant client. It's up to you how you want to do it, as long as it does not go into your own bank account and you don't call it a trust account. Deposit client monies without delay. Now, they don't give us a definition of what is without delay, but we know from experience that in the attorney's trust account, it says on the same day or the next business day. Maintain such records as may reasonably expected to ensure that the client monies can be readily identified as being property of the client. Don't mingle it with your property. You must do reconciliations between the bank accounts, exactly like we do in attorney's trust accounts. Not hold the client's money indefinitely. There must be a specific purpose. You can't have an investment account, so you can't keep the client on the money as an investment on your side. You're not allowed to do that because you're not registered with the Financial Services Board to do things like that. And auditors are encouraged to hold the client money only for a limited period. So if the client asks you to hold it just to pay tax later or to make a payment to some creditor or something, you just hold it for that limited period. Same for assets. It's not held in trust account. Also maintain your records and make sure that you can record for it at all times. Yes, implementation rules to follow when to protect the client assets. Where it's a large number of client accounts are administered, try to utilize an umbrella account, okay, with a sub-account for each client. If the professional services require client monies to be held for an unusually long period, and you're not the auditor or the assurance provider, request the client to open the bank account. So if the client is going to say it's only to stay there for 1 year, it's a long period of time, you may not open that bank account. Ask the client to open a bank account and then they can give you rights to that bank account. Make sure your indemnity and your fidelity insurance is sufficient to cover the incidents of fraud and theft. If you don't have indemnity or insurance, don't take that money, and there must be a formal engagement letter that you enter into with the client that sets out all the rules and all the requirements and everything for holding that money or assets. So what is in red is for IRBA members only. I want to get to signing off reports. Very important. You can see everything here in red. This deals with who may sign a report in your firm. It says you may not delegate to any person who is not a partner or a fellow director the power to sign any audit, review, or assurance report. So you may not do it. You may not let anybody who's not a partner or a fellow partner to sign those reports. But if there's an emergency, what if you end up in hospital, you sit overseas, something needs to be signed urgently, then you can delegate it to somebody else. But look at the rules. You need to tell the client, you need to report it to the client, and you need to report it to IRBA, and you need to get the written consent from IRBA to do it. Please, ladies and gentlemen, remember these rules. You may not delegate the signing of a report to anybody else. If you do it in an emergency situation, you need to inform IRBA, you need to inform the client, and you need to get the permission of IRBA to do it. The engagement partner that is responsible for the audit or the other assurance work must, when they sign the certificate, write down the following on that report. The engagement partner's full name, the capacity in which the engagement partner is signing it, like RA, the designation registered auditor underneath the engagement partner's name, and if the name of the firm is not on the letterhead, the name of the firm. If it's on the letterhead, you don't have to put the name of the firm down. Very, very strict requirements here. Gifts and hospitality, you can make a big note, new. This is all new. Giving gifts and receiving gifts is not new, but there's a whole new section. It's not just two-liners anymore that say you may not accept gifts that are significant or more than a trivial amount. All right, so they do give us some guidance here. And they say that the objective to improperly influence a person's behavior, that is not allowed. It says it can range from minor acts of hospitality between business colleagues to acts that result in non-compliance with laws and regulations. we touch more here on things like bribery. Example of these gifts. Make a note of this because this is the first time that we see these things. Any gift, any hospitality for whatever nature, any entertainment, political or charitable donations, appeal to friendship or loyalty, employment or other commercial opportunities, preferential treatment, rights or privileges. So make sure you understand this. Make sure you convey this to everybody in your firm. Then it says, the conceptual framework, that three-step approach, will apply when there's no actual or perceived intent. So if you find that, well, I get a gift, but really the intent is not to make me change my ways or do things that I don't want to do, then you're going to apply the conceptual framework. For inducements that are trivial and inconsequential, the threats created will be at an acceptable level. But what is trivial and what is inconsequential, you need to decide. Okay, so you need to go and decide. You need to say, okay, anything above or below 100 Rand, is it 500 Rand, is it whatever, you're going to put that amount in. Now, what you're going to do is you're going to have a gift register in your firm, and you're going to have a policy. Now, that manual that I showed you, in that manual, you're going to say, what is the policy? Like say, everything above 100 Rand is seen as not trivial and inconsequential, and you shall write it in a gift register, and your gift register say, please document all gifts above 100 Rand. I don't know what you're going to decide in your firm, but that is one, like an example of the policies that you need to go and tailor in your manuals. But now it gives us more guidance, and it says circumstances where offering or accepting an inducement might create threats, even if there's no actual or perceived intent to improperly influence the behavior. So the intention is not that it will influence behavior, but the code says it is a threat. And please take note of these three things here. Where you've got a professional employee that is offered part-time employment by a vendor. Your employee often part-time employment. It is a threat. Doesn't matter what the intention is. It can be a good intention. It doesn't matter. There's a threat. Where you've got a professional employee regularly takes customers or suppliers to sporting events. And when a professional employee accepts hospitality, the nature of which could be perceived to be inappropriate when it's publicly disclosed. Please watch out for these three things. This is really important that you convey this to everybody in your firm. Also, the test that you need to apply again is RIP. How big should that amount be? What should be perceived to be inappropriate? Well, what will RIP say? Safeguards that you can, if something like this now happen, inform senior management or the offerer regarding the offer. Everybody needs to know. The senior management in your firm needs to know about that offer, or the offerer, also whoever that is, needs to be informed of this. Amend or terminate the business relationship. Decline or not to offer the inducement, not to receive it, not to offer it. Transfer the responsibility of a business-related division involving the counterparty to another individual. Be transparent with senior management. And it must be documented in a gift register. So where is your gift register? And can everybody have access to that register? Do everybody know where it is? And what is that amount above which they need to document everything? Even if it's a slab of chocolates. If you say that that amount is 0, you want all gifts, anything to be documented in the, so be it. If it's a slab of chocolates, the person must come and document it in the register. So gifts and hospitality, new, few strict rules, a lot more information and guidance than we had in the past. Right now I'm going to work on independence requirements applicable to assurance engagements. Again, I'm not going to go through everything because most of these things are familiar to us. We know that we cannot have shares. We know that we cannot have loans in the client, etc. But what I want to show you here are all the safeguards. How do you deal with the safeguards when there are specific threats. Just before we start with this, we all know that auditors and independence requirements for auditors are now under scrutiny. It's in the limelight. Everybody is talking about it. Here's just a few quotes from people that saying in the last couple of months that had something to say about our profession. The crisis should be seen for what it really is. Fear greed. It's about chasing fees. That is what our profession is where it's going to with things. We don't think about the work and the public interest. We're just chasing fees all the time. It all starts with directors getting too close to the assurance watchdogs. We need to have better oversight and we need to hold people accountable. That was Rory Waller from CIPC. The auditing profession watchdog IRBA firmly believes that auditors are not sufficiently independent and driven by a lust for money. Professionalism has been taken over by commercialism. Partners at the firm are measured on the revenue they generate and the clients that they attract to the firm. That was said by Bernard de Gallas of IRBA. They call for mandatory audit firm rotation. We know that that is in place now. There was a big fight about it, but IRBA won that fight. So as from 2023, there will be mandatory audit firm rotation. If they say here, when an auditor knows a fresh pair of eyes will be looking at their work, they will be less keen to try and hide things. And there was also this remark that said accounting firms should not be allowed to perform different services, types of services to the same audit client. So this is also something that was said that needs to be considered maybe. So these are the things that people are saying about our profession. So we know we're in trouble. I don't have to tell you this. We all know this. And this new, hopefully with a new code, well, we hope so, everybody will start doing the same thing and apply their minds here. Same things as in the previous code, independence of mind, independence of appearance, and you need to apply the conceptual framework to identify, evaluate, and address threats to independence. So the framework is not only to apply your fundamental principles, the framework is also there to make sure that you are independent. Independence of mind and independence of appearance. Remember, a lot of people can, in their minds, think they are independent. But for RIP, it would not appear so. You could have the example that I always use is you've got a husband and wife in the same practice. So they want to do an independent review. So let's say the husband writes up the books and the wife does the independent review, vice versa. And they say, okay, we are independent. We vouch never to talk about our work at home. We will not talk to each other and about the engagement. We will keep it strictly professional. I don't know. What would RIP say? RIP standing here and looking at a husband and wife working together in the firm on the same engagement. I don't know. What would RIP say? What would you say? I think you all have your opinions on that. So if you say, well, I don't think they can be objective. If they're too close to each other. I mean, husband and wife, yes, they can say in their minds, they can convince themselves in their minds that they're independent. But for RIP, they don't appear to be independent. All right, so watch out what our minds tell us. Our minds can tell us a lot of things, but if we ask RIP, RIP would have something else to say about it. Professional skepticism is a new concept in the code. It's not a new concept in auditing, because we know from many years now that they talk about professional skepticism in auditing. Professional skepticism, I just want to go through a very quick, practical example of how we should be professional when we do audits and assurance work. Remember, we're talking about audit and assurance work here now. You need to be skeptical. My interpretation of this is two things. Trust nobody. Trust nobody. Trust nothing. Trust nobody. Trust nothing. Now, for trust nobody, I've got a 4-step approach that we implement. I say, you ask the client for information, but you can't trust the client. So you want to back it up with hard evidence. So number 2, you're going to say to the client, show me the information. Are you registered for VAT? Yes. Show me the VAT registration document. Now we're even more skeptical. Inspect the document. Inspect the document. Number 4, document your conclusion. This is how you're going to document in your files that you are skeptical. Trust nobody. You can never just document what the client tells you. Unless they can back it up with hard evidence, it's not acceptable. Trust nothing. Here we talk about client-prepared documents. Client-prepared documents. You're going to get hundreds of client-prepared documents during an audit. I'm also talking things that comes from an accounting package like Pastel. What about the debtors age analysis? What about a fixed asset register that was done on Excel? I mean, there could be errors there. So you can't just accept anything. You can't accept anything that the client gives you, any client-prepared document. You shall cast the document, you shall cross-cast the document, and you shall recalculate the document. That is why you see these things always in your audit programs. You may never, ever put a document in your file that you got from the client that you didn't cast, cross-cast, or recalculate it. Even if it comes from a machine like a computer and you think, oh, but what can go wrong here? It doesn't matter. You shall still cast, cross-cast, and recalculate that document. All right, so professional skepticism, I just want to emphasize the fact here that you need to be very, very skeptical. Query everything, be very skeptical. I'm just going to skip over a few slides here. The breach of an independence provision is what I want to discuss now. If you want to just catch up with me in your slide presentation, the breach of an independence provision. So if there was a breach, you're doing the audit, you got your affidavit signed, the declarations were signed by all the team members, and now suddenly during the audit, you see somebody breached, or a trainee maybe realized that they breached the independence requirements. So maybe they rock up at a client and there they see, oh my goodness, but the financial director here is a family member of mine. I didn't know that. All right, so what should you do? You must end, suspend, or eliminate the interest or the relationship. Consider any legal or regulatory requirements, and this is the important one. Please highlight this one for me. Consider reporting the breach to IRBA. If it's such a big thing, consider reporting it to IRBA. Promptly communicate the breach to, if you're a trainee, to your engagement partner or those with responsibility for policies and procedures. Now, I just want to show you something quickly here, what you're going to do when you do your manuals. Just quickly want to show you how it's going to work. One of the first things that you're going to do in the manual is you're going to appoint people responsible for certain things. Let me see if I can quickly find one. Ultimate responsibility, for example, these policies and procedures require the firm to, it's the managing partner, is it the managing director, the managing board of partners, the engagement partner, the partner responsible for ethics and independence. So somewhere in this manual you're going to say, there's a partner responsible for ethics and independence, Mr. X. Right, you need to tell the people in your firm who that person is. So every time that you select something and you say this person is going to be responsible for this, that one is going to be responsible for that, you need to inform everybody in the firm so that when there's a breach of independence, they know exactly who that they need to communicate to. So are they going to, you need to communicate to the partner, you need to communicate to the responsible person responsible for policies and procedures, any other relevant personnel in the firm. So you need to have a policy. Which path should they follow? Who should they report that to? But remember, reporting the breach to a regulatory body. Consider that. Very important. Safeguards. Remove the individual from the audit team. Use different individuals to conduct an additional review of the affected audit work or re-perform that work. So now the trainee realized that a family member is the financial director. He already did part of the audit work. You need to either get it redone or reviewed it. Recommend that the audit client engage another firm to review or re-perform the affected work. And if the breach relates to non-assurance services that affect the accounting records or an amount recorded in the financial statements, engage another firm to evaluate the results of the non-assurance service or re-perform the non-assurance service to the extent necessary to enable the other firm to take responsibility for the service. So it's strict requirements. If you find a breach of an independence provision, if you already have done some work, you need to take serious action to eliminate that threat. Also, what you need to do, you need to communicate in writing to those in charge with governance. So you also need to inform your client. And you need to obtain their concurrence. You need to say to them, listen, Joe here with me, he now realized that your financial director is a family member, too close for comfort. Can we continue with the engagement? You need to tell them, what is your firm's policies and procedures relevant to the breach? What are you going to do? So you're going to remove Joe immediately, and you're going to get somebody to redo his work. Any steps taken to reduce or avoid the risk. If those charged in governance do not concur, so they say, no, we don't like this situation, you need to end the audit engagement immediately. Strict rules, please make sure you understand this. This breach of an independence provision is really, it's not new, but it is something that we need to bring to your attention to make sure that everybody knows about it. If there is a threat to independence in your audit files, this is crucial that we all understand how this works. If you got a threat to independence, you need to document the threat, plus you need to document your safeguard. So for example, a voluntary audit already has a self-review threat. You cannot get away from that. You cannot wish it away. If you do voluntary audits and you don't document the self-review threat in the file and you don't apply a safeguard, IRBA is going to take you out. Because if you do a voluntary audit, you are preparing financial statements and you're doing the audit in the same firm. So the threat is there. It will never go away. IRBA is going to look at these things. They're going to open that file. They're going to see you doing a voluntary audit. They're going to see you didn't document any threat. They're going to give a fine or a penalty for that. All right, so you need to document the breach. What actions did you take and what is your safeguards? What's your key decisions? Did you discuss anything with those in charge of governance if there's a breach of a independence requirement? And all discussions with IRBA also needs to be documented. Fees. If your audit fees represent a large portion of the total fees, unfortunately, you got two options. You either need to increase your client base, which is not always possible, and if you can't do that, you need to appoint a reviewer to review your work. So if you got one big client and it's a large proportion to your total fees in your firm, usually you got this problem in your smaller firms, then unfortunately, this is what you need to do. Overdue fees. If a significant part of fees remains unpaid and you can say, well, actually I'm now a bank for my client, you got a problem because it is a threat and you need to consider whether it's appropriate to be reappointed. What safeguards can you apply? You need to obtain partial payment of the fees, otherwise you can't do that audit. Or if they don't pay and you still have to start the audit, appropriate reviewer. Like I'm just showing you these things because this is your options. Like I said, you can't guess, you can't make up your own story, you can't make your own rules. You need to stick to these rules here. Contingency fees, you may not charge contingency fees for assurance engagements. Okay, so that is just a normal rule. We're all aware of that. And if you're going to charge any contingency fees, you need to obtain the advance written agreement from the client. Please remember this, make a note of this one. Any contingency fees, obtain the advance written agreement from the client. Compensation and evaluation policies. You may not compensate an audit partner for the success in selling non-assurance services. So you can't pay commission or bonuses to an audit partner for selling non-assurance services to an audit client. Please just take note of that. I'm not going to go every time through the safeguards, because they rules. You can just go and have a look at them when you get into the situation. So all that I'm highlighting to you are the key issues. We did talk about gifts and hospitality. You may not accept gifts or hospitality unless the value is trivial and inconsequential. This is what you're going to put in your gift register. You may not accept gifts and hospitality where the intent is to improperly influence behavior, even if the value is trivial and inconsequential. If it's a slab of chocolates and it is there to make you feel better the day and to think you think the client wants you to change something, then even if it's just a slab of chocolates, it is not allowed in terms of the code. Actual threatened litigation, if it involves an audit team member, so maybe they did something wrong, then you remove that person from the audit team. Okay, you have to remove that person from the audit team. Financial interests. Now I'm just going to give you a overall, let's say, refresh your memories here again. You may not have any financial interest in an audit client. We all know that. You may not have shares in the client. Okay. And one thing that they talk about is they say, when you determine whether an interest is material, you need to take the combined net worth of the individual and its immediate family members. So if you think about any, let's say, an interest in a client of an individual, let's say a team member, it's the team member plus the immediate family member of the team member, you need to take the combined net worth of that interest. All right, not only looking at the individual, but also at the immediate family member. A financial interest in an audit client shall not be held by the firm or the network firm or the team members or their immediate family, other partners in the office or the immediate family, other partners or managers who provides non-audit services or the immediate family. Right, highlight this one. This is important. Okay, no financial interest by any of these people. When it comes to a trust, there's a very strict rule. You may not hold a financial interest in an audit client held in a trust where you act as the trustee, where the firm or the network firm acts as the trustee, unless none of the following is a beneficiary of the trust. The trustee, any audit team members, or their individual immediate family, the firm, or the network firm. Okay, you may not hold interest in an audit client if it's held in a trust unless none of these people are beneficiaries. Highlight this. It's also an issue that comes up quite a lot. I'm just going to skip through this. Loans and guarantees. You may not have a loan in a client, make a loan to a client unless it's immaterial. If it's a bank, it must be done under normal lending circumstances, then that is fine. If your client is the bank, okay, and your staff members makes a loan or gets a loan from the bank, unless it's under normal lending conditions, then it's fine. And you may not have deposits or brokerage accounts with an audit client that is a bank. Okay, but the main thing is here, in an audit client, you may not make a loan, you might not make a loan to the audit client, you may not receive a loan from an audit client. Okay. Business relationships, things that are prohibited. Any joint venture with the client, arrangements to combine services or products, so you're going to combine it and you're going to sell it together, and distribution or marketing arrangements where the firm distributes or markets the client's products or services, or the client distributes or markets the firm's products or services. Prohibited. May not do it. Okay, please take note. What about if you buy from a vendor, if you buy from an audit client, your audit client sells stationery and you buy from them, is that prohibited? No. That is fine as long as it's in the normal course of business and you pay the normal price. It's an arm's length price, but still it is a threat just eliminate or reduce the magnitude of the transaction if it becomes too big, if it becomes a threat, or remove the individual from the audit team. Family and personal relationships. We all know that your individual shall not participate as an audit team member if the immediate family is a director or an officer or an employee who can have influence on the preparation of the financial statements. Okay, so if a family member is a director or an officer or an employee involved in the preparation of financials, you cannot have that audit team member in the team. Your safeguards, remove the individual from the team or structure the responsibility of that team member so that it doesn't deal with matters where that person is, that immediate family member is involved in. This doesn't happen often, but let's just quickly go through it. Serving as a director or an officer of an audit client, a partner or an employee shall not serve as a director or an officer in an audit client. It may not happen. That's why I say it doesn't happen often. You may not do it. It's completely, totally prohibited. Also not as the company secretary. Please watch out for this, company secretary. If you are performing statutory audits and if you're performing public interest entity audits, your firm may not be the company secretary. There's so many clients that got fined by IRBA because of this. Please go to CIPC, check where your name is still listed as the company secretary. Best thing you can do is to remove your name everywhere. Otherwise, IRBA does look at it. Some people forget that years ago they was appointed as the secretary, maybe in another firm closely related to your firm. Maybe you started another practice to do that. You closed it down in the meantime. That practice, they still registered at CIPC as the secretary. You totally forgot about it. IRBA is giving huge penalties for that. Please take note of that. We know you're not allowed to serve as a director or officer, but also watch out for the company secretary. Employment with an audit client. If you got a partner who joins an audit client or a team member who joins an audit client, there must be no significant connection between you and that partner or the audit team member. Say goodbye, have his farewell, and that's the end of your relationship with that person. Please break all ties with that person. When a former partner has joined an entity and then that entity becomes your audit client, you need to do one of the following. Modify the audit plan, assign an audit team, the audit team individuals who have sufficient experience to deal with that matter, and have an appropriate reviewer review the work of the former audit team member. This is the case for normal audits. Please, what I'm telling you now is for normal voluntary audits or other type of assurance engagements. It is not for public interest entities. In a public interest entity, you cannot take on that audit for a period of 12 months. If the partner joins an audit client, your firm needs to resign. You cannot sign financial statements for a period of 12 months. But if it's not a public interest entity audit, then obviously if it happens, you don't have to resign as the auditor. Just make sure you put your safeguards in place. Audit team members, trainees, listen carefully. Audit team members must notify the firm when entering into employment negotiations with an audit client. It's a requirement. It's a little bit of a difficult one because now they're entering into negotiation, they're on the audit, the client approached them, say, come and work for us. Now they need to go and inform the firm. Nobody is going to be very happy. The firm is not going to be very happy with that person. What if they don't get the job at the end of the day? But unfortunately, trainees, listen carefully. You have to do it. If they find out later that you were negotiating with a client while you were on that audit, it's going to have serious consequences for your career as an auditor. The safeguards, when you go to the partners and you tell them about it, the safeguards, immediately remove that individual from the audit team or get an appropriate reviewer to review the work of that individual while on the team. But I'm just going to repeat it. Trainees, if a client approaches you, immediately go and tell the firm. If they find out later that you did not tell them and you continue to work on the audit, it's going to have, remember, SAICA is going to become involved, IRBA is going to become involved here. It's a breach of an independence requirement. Unfortunately, it has to be reported to IRBA. Please, please take note of this. Temporary personnel assignments. Your client is got a calamity, the bookkeeper is sick, the accountant is not there, the work is standing still. Can you loan your personnel to an audit client? Well, what does the code say? You may not loan personnel to an audit client unless it's for a very short period, maybe a day or two or a week. They're not involved in providing non-assurance services that would not be permitted. Okay? And the personnel do not assume management responsibilities. So maybe they're just going in and quickly help to do the VAT return for the month because the accountant is off. Yes, that's fine. That's fine. It's not the end of the world. Safeguards. Conduct an additional review of the work performed by the loan staff. So let's say for a month they wrote up the books of the client. Then that work needs to be reviewed, additional review. Not including the loan personnel as an audit team member. Not giving the loan staff audit responsibility for any function that they perform during the loan assignment. Okay, just basic stuff, basic things, but stick to the rules. Don't make up your own stories. Yeah. Here's a new thing in the code. This is what I want to talk about now. Long associations with personnel with an audit client. This is new. This is a new part in the code. Not so strict for normal audit engagements, but very, very strict for public interest entity audits. I will get to the PIs later on. All that I'm talking about now is the other type of audit, your voluntary audit, your other assurance engagements. It says, where there's a concern about losing a long-standing client, you shall apply the following safeguards. So what they say here is that if you had the same person as the senior, let's say now for 10 years, and now you start to get worried, but yes, this 10 years, it's a long time. I mean, I think this person is getting too familiar with the client. You have to rotate the individual off the audit team. This is a decision that you need to make in your firm. You really need to consider it. You can't just keep on having the person on that engagement, being the senior year after year after year. You have to consider if it's not maybe time to rotate the person or change the role of the individual on the audit team, or have an appropriate reviewer to review the work of that person. And the code says you need to perform regular, independent, internal or external quality reviews on that engagement. Quality reviews is that monitoring part that we've got in our ISQC1. Oof. If the firms decide that the level of the threat created can only be addressed by rotating the individual of the audit team, so if you're going to go for that one there, the firm shall determine an appropriate period during which the individual shall not be a member. Have a policy in your firm. So no senior may be on the audit for more than, let's say, 5 years. What is your policy? They're going to ask you for your policy there. Provision of non-assurance services to an audit client. You may assume a management responsibility for related entities. I don't want to spend too much time on this now. You can do work and provide non-assurance services to related entities. A related entity for a listed entity. A listed entity is any entity related to a listed entity is a related entity. For any other entity, it is where they have control over that entity. This is what the code says. So A has control over B. So B is the related entity. You can do work for B, okay, if the following conditions are met. The firm does not express an opinion on the financials of the related entity. So you can provide non-assurance services to B as long as you don't audit B. The firm does not assume a management responsibility. So you don't take over the management of B and do management things for B. And the service do not create a self-review threat, because the results of the service will not be subject to audit procedures. All right, so all that you need to know is that you can provide non-assurance services to B or with your audit client. You can provide non-assurance services to B as long as you don't do an audit on B, and it will not create a self-review threat. You don't take over the management responsibilities, and it does not create a self-review threat because the results of the services will not be subject to audit. But you may not do an audit on that in any case. The more important one, if you just want to catch up maybe with your slides, now I'm going very quickly through this. Accounting and bookkeeping services. It says it comprises a broad range of services, preparing accounting records and financial statements, recording transactions, payroll services, to mention a few. Here it is. Please, you may not provide accounting and bookkeeping services, including the preparation of financial statements on which your firm will express an opinion, or the financial information which forms the basis of such financial statements, unless the services are of a routine and mechanical nature and the threats created are at an acceptable level. If you prepare the financial statements, here are your safeguards. Now please take note. This is the one that I really want to highlight today. Use professionals who are not team members to perform the service. Split your teams. Have one team to prepare and one team to audit. That's one safeguard that you can apply. The only other safeguard is you need to bring in another reviewer who was not involved in providing the service to review the audit work or the service performed. Which one is the best option? I think splitting your practice. It's the cheaper option than to bring in this appropriate reviewer. This appropriate reviewer will be another qualified person. You're going to pay the partner's fees. It's the partner's fees and this professional fees for this person here. It's a very expensive option. But obviously, if you don't have a choice, you don't have enough team members to do this, then you need to do this one. Ladies and gentlemen, this is the options that you've got. This is the safeguards that you must apply if you prepare financials in the same firm. Think about this one. What is administrative and routine and mechanical? Where there's little or no professional judgment. Clerical in nature. Preparation of financial statements is not routine or mechanical. So I just want to go back here. Unless they are of a routine or mechanical nature, or your threats are at an acceptable level. Okay, so if you've got a threat, you need to apply these to reduce the threat, but definitely preparation of financials requires a lot of professional judgment, and it's definitely not clerical in nature. Examples of that is word processing services, prepare statutory forms, submit forms like your CRPC forms, etc., and monitoring statutory filing dates. You may provide administrative services only if the threat created is limited to an acceptable level. Right. Apply your safeguards. Valuation services. Interesting one, this one. Audit client comes to you and say, can you do a valuation for an amount that needs to be used in the financial statements? You may not do it. You may not do it. If it involves a significant degree of subjectivity, which all valuations usually do, and the valuation will have a material effect on the financial statements, you may not do it. If it's immaterial, you can use professionals who are not team members to perform the service, or use an appropriate reviewer. So just watch out for valuations. It's exactly the same for public interest entities as well. If that valuation is going to have, if the valuation is going to have a material effect on the financial statements in a public interest entity, you may not provide that service. Tax services, normal audit lines. Yes, you can assist with tax services. You can prepare tax returns. It doesn't create a threat. You are permitted to provide tax return preparation services if the threats created are eliminated or reduced to an acceptable level. You may not prepare calculations of current and deferred tax assets unless the following safeguards are applied. If they're going to have a material effect, which they usually do. May not prepare calculations of current and deferred tax assets that will have a material effect on the financials unless you've got the following safeguards. Use professionals who are not team members to do the calculations, or use an appropriate reviewer to review that work. So let's just summarize again. You can do the tax calculations of a client. Normal tax, deferred tax assets, deferred tax liabilities, if you have your safeguards in place. This is for normal audits. It's not for public interest entity. You may not do this for public interest entities. You may not provide tax planning or other tax advisory services or tax valuation unless you've got the safeguards in place. Again, make use of professionals or not team members to perform the service, or an appropriate reviewer must review the work. And look at this one. Or you obtained pre-clearance from SARS. Make a note of that one. You need to obtain pre-clearance from SARS. Internal audit services. In a normal audit client, you may not accept an engagement to provide internal audit services where the results of those services might be used in conducting the external audit unless professionals are used who are not in the audit team. You can provide internal audit services as long as the client takes full responsibility for the internal audit. So you're just helping them with the internal audit service, but your people that you use, that you give to them to or do the internal audit services, they work under the supervision of the client. So the client must be responsible for the internal audit activities. They must acknowledge the responsibility for the design, the implementation, the monitoring, and the maintenance of internal controls. Your trainees or your people are just going to assist. But in an audit, if they assisted the client with internal audit services, they may not be part of the audit team. You may provide information technology services as long as the client decides on what to implement. You can make recommendations. You can tell them what package you think they should use, but they must make the final decision. But if you do have people in your firm providing services to your audit client, when you do the audit, use professionals who are not audit team members to perform the IT service. So that's your only safeguard. So you can provide all the IT services that you want, as long as the client stays responsible for making the final decisions. But the people who provided the IT service may not be on the audit team. Litigation and legal, I'm just going to skip over this because I want to get to recruiting. Now, this is a big change. Please note this is new. It's not new in terms of them, but it's new rules. New rules. So I'm just give you a moment to catch up with your slides with me if you want to. When it comes to recruiting services, in the past, we could, if it's a normal audit client, not a public interest entity audit, we could assist our clients to looking for candidates, interview the candidates, make recommendations, etc. Now it's changed. You may not act as a negotiator on the client's behalf. I think that was always the case. You can't negotiate with a person. You can't be part of that process. But this is now the rule, change in the rules. You may not provide a recruiting service if the service relates to searching or seeking out candidates, undertake reference checks of prospective candidates with regards to the following. If they are a director or an officer or a person who will be part of the preparation of the financial statements. You cannot do reference checks for prospective candidates if it's going to be a director or an officer or a person who's going to, they say, in a position to exert significant influence over the preparation of the client's accounting records. Please, if it's something else, if you do provide recruiting services, your safeguard is use professionals are not audit team members to perform the service. So they should not be audit team members if they're going to help you with recruiting, helping the client to recruit. Big change. Please take note. Highlight this. Make sure you remember this. Okay. These I'm just going to skip through. It's not something that we deal on a daily basis. I just put it in for completeness purposes so that we can talk about public interest entities. Public interest entities. Before I talk about public interest entities, I just want to say to you what you need in your firm. The very first thing that you're going to do when you implement your manuals now, you should have done it already in the past. It's also in the new manual. You're going to have a schedule of all your clients. You're going to have a list of all your clients, 1, 2, 3, 4, 5, how many clients you've got, and you're going to say, is this client a voluntary audit? Is this client a statutory audit? Is this client a public interest entity audit? Is this client a other type of audit? Or is this client an independent review? And you're going to go through every one and say, what type of client do you have here? IRBA wants to see this schedule. They want to see this schedule. When it comes to public interest entities, you need to carefully look at all your clients to see if it's a public interest. If it's not a statutory audit, but there's public interest in that entity, you should seriously consider if it's a public interest entity. Now, here's the definition of what you need to consider. If you decide, you can rebut it. This is what it says. Every firm must go through the client list, and where you've got client public interest, if it meets this definition here, you need to see if you're going to treat it as a public interest entity. But if you rebut it, you say, well, for so-and-so reason, I'm not going to treat it as a public interest entity. Please remember your reasons must be very valid. You need to seriously consider this definition here. And my advice to you is use a process of elimination. So is it a public interest? Is it listed? No. Does it meet this one? No. No, 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 no. Okay, I've looked at the definition. I've used the process of elimination, and therefore it's not a public interest entity. Please be very careful with this. If you've got a client and you're going to say for whatever reason it's not a public interest entity, and IRBA comes in and say, but you got it wrong, this is a public interest entity, you're supposed to follow the public interest entity rules, it's a huge, huge fine. Okay, so please be very careful here. So let's go through the definition. Any listed entity, obviously, is a public interest entity. Any entity defined by regulation or legislation for which the audit is required to be conducted with the same independence requirement that apply to the audit of listed entities. Other entities, this is all your public entities, but a public entity will be under a statutory audit. Okay, for our sake here, remember this is this is a world definition here for the whole world. Our public entities will fall under statutory audits. Other entities, because they have a large number and a wide range of stakeholders. So you could have a non-profit organization with a lot of people involved in that non-profit organization. So the public will benefit from that non-profit organization. It's not a company. It's not a company, but it is a lot of public interest in there. So therefore, that will probably be a public interest entity that you need to deal with. Determine whether to treat additional entities as public interest entities. Factors to consider: the nature of the business, such as the holding of assets in a fiduciary capacity for a large number of stakeholders, the number of equity or debt holders, how many creditors, how many debt holders, how many people has a stake in that entity, the size of the entity, and the number of employees. Public interest score that you calculate can give you an indication, but it's not to say that if you've got a high public interest score that it is a public interest entity. So a public interest entity and public interest score are two different things. If you've got a public interest score that is high enough that warrants a statutory audit, then it's already falling under a statutory audit, and there is very strict rules under the Companies Act here. All your other clients, you need to go through this definition here. Please take time, consider every single client. Take, for example, you got a client who is dealing with hospice maybe, or anything that where there's public interest, big body corporates maybe with hundreds of unit owners in there. I don't know, maybe those needs to be audited in any case, but are you going to audit under normal terms, or are you going to use it audit under public interest entities? That is the question now. This is the list that is in IRBA. You can see it's in red. This is the list in IRBA's code. I'm not going to go through it. This is definitely public interest entity. This one you can't get out of it. You can't rebut yourself out of this one. It's definitely public interest entities here. So take note of that. Now here is the rules with regards to public interest entities. If you've got a partner that joins an audit client, you cannot be the auditor for a period of 12 months. So serious problems if the client is a public interest entity and the partner goes and joins the client, you may not be involved in an audit unless 12 months have passed from the date that a senior or a managing partner joined the audit client. Right, please take note of that one there. I did put it in red, but it is not a only South African requirement. It is just a normal requirement, but I did want to highlight this to you. So I'm just going to repeat that. If an audit partner joins, or a key audit partner joins a client, a senior or a managing partner, you may not be the auditor unless 12 months have passed from the date of that appointment. Now this you can make a big note. This is new. All of this that I'm going to discuss with you now is new. Long association of personnel, including partner rotation. Now I just want to do a quick summary of what we had before this change in the code. If you do a statutory audit in terms of the Company Act, that is now where your public interest scores more than 350, it's a public entity or a listed entity, you hold assets in a fiduciary capacity of more than 5 million rand, it states in the MOI that an audit is required, then you do a statutory audit. Then you can be the auditor for 5 years, and then you need to go and cool down for 2 years. So that requirement is still there for a statutory audit. For a public interest entity audit, the requirement was always 7 years and 2 years cooling off. So this is what we always had. Statutory audit, 5 years, 2 years cooling off. Public interest entity, 7 years, 2 years cooling off. Now this has changed this year. Big change. So for your public interest entities, please take note. Remember, this kicks in 15 June. 15 June. It says, an individual shall not act in any of the following roles or a combination of such roles for a period of more than 7 years. So the 7 years stays the same. They call it the time on period. That's the engagement partner, the EQCR, and any other key audit partner role, second partner or other key audit partner role, 7 years. Under exceptional circumstances, a key audit partner whose continuity is especially important to audit quality may, in rare cases, due to unforeseen circumstances outside the firm's control, and with the concurrence of those in charge with governance, be permitted to serve an additional year as the key audit partner, only if the threat to independence can be eliminated or reduced to an acceptable level. So 7 years max, unless there is exceptional circumstances. Really, it must be exceptional. Don't even try just to use this as an escape clause to stay on another year. You may not do it. in exceptional circumstances outside your firm's control. You can stay on another year. You have to discuss it with those in charge with governance. The reason why the planned rotation cannot take place and the need for any safeguards to reduce any threat created. Now here's your cooling off period. Now remember, it's this 2 years that is now changed. This 2 years has changed. When an audit client becomes a public interest entity, consider the length of time an individual has served as the audit client, as key audit partner, before the client became a public interest entity, in determining the timing of the rotation. Okay. So if the partner was there for 5 years or less, 7 years, less the number of years already served. So let's say they were the partner, it wasn't a public interest entity, the partner was the auditor for 3 years, now they become a public interest entity, they can stay on for another 4 years. So 7 years, less the number of years already served. If they've been a partner for 6 or more years, they can stay on another 2 years, because that will take them to 8 years. But with the concurrence, the permission of those in charge with governance, they must give you permission that you can stay on for, then it will be a total of 8 years. Your cooling off periods now. If a person was the engagement partner for 7 years, your cooling off period is now 5 years. Okay, I just want to go back here. This 2 years now changed to 5 years. Cooling off period, 5 years. If a person was an EQCR for 7 years, 3-year cooling off period. If it was a key audit partners for 7 years, 2-year cooling off period. Any combination of a key audit partner and served as the engagement partner for 5 or more years, 5 consecutive years. Combination of key audit partner roles and served as the EQCR for 4 or more cumulative years, 3 consecutive years. Okay, a lot of things to remember. I did bring in all of these things in the manual for you as your policies. So, and I summarize it very nicely for you in your policies. So your manual will already have this in. You just need to apply the rules here. Combination of an engagement partner and EQCR for 4 or more cumulative years, 5 years where the individual has been the engagement partner for 3 or more years, 3 years in the case of any other combination. Any other combination of key audit partner, 2 years. You can see, we're not going to remember this. I know you're not going to remember this, but at least you know now that there's different cooling off periods. So you need to have a schedule. That schedule that I was talking about, just to go back to the schedule that I was talking about here, what you're going to do is when you got your public interest entities here, you're going to have another column to say who's the partner, who's the key partner, and who's the EQCR. How long have they been partner, key partner, or EQCR on this engagement, and have a rotation schedule. Okay, they're going to ask you for a rotation schedule. The relationship shall also include time while the individual was a key audit partner on the engagement at a prior firm. Okay, so please bring into this considerations if it's a partner that came from another firm. When you merge firms, you also need to take that time that the partner was the partner there in that merger as well. What may you not do during the cooling off period? Cooling off period means go and cool off. You may not have any involvement at all. You may not be an engagement team member or provide quality control for the audit engagement. That monitoring review, you may not do that as well. You may not consult with the engagement team or the client regarding technical or industry-specific issues, transactions or events affecting the audit engagement. The engagement team cannot come to you and say, oh, you know, you've been the partner for a long time and you've got a lot of knowledge, help us here with this engagement. You need to say to them, speak to the hand, I cannot talk to you. Unfortunately, I'm cooling off. Don't talk to me. You may not be responsible for leading or coordinating the professional services to the audit client or overseeing the relationship with the audit client. or undertake any other role or activity, including the provision of non-assurance services that were of a result, the individual having significant or frequent interaction with management, exert direct influence over the outcome of the audit engagement. So you may not even do other work, other non-assurance services for that client when you cool off. So what I usually say to people is when you cool off, you cool off. Don't get involved, don't consult, don't talk to the team members, don't talk to the client, go and cool off for that period of time. I want to talk about the provision of non-assurance services. So the first one that I want to talk about here is accounting and bookkeeping services. Now remember, for a voluntary audit or other audits, you can do accounting and bookkeeping services. The only condition or requirement there is that you need to make sure that you have your safeguards in place. For a public interest entity, you may not provide these services at all. There's no safeguard that you can apply. You just may not do it. You may not provide accounting and bookkeeping services, including the preparation of the financial statements, of which an opinion will be expressed. As an exception, and I don't even want to look at these exceptions because some people read it and then they think they can do it. As an exception, accounting and bookkeeping services of a routine or mechanical nature for a division or related entities may be provided. But these divisions or related entities must collectively be immaterial to the financial statements. So again, we've got A and B is a related entity, and we can do these bookkeeping services for B. But when they consolidate B in A, this division must be so immaterial that it will not even make a difference. The service relate to matters that are collectively immaterial to the financial statements. So for example, in B, I don't think you can go and provide payroll services because payroll is a material amount in your financial statements. Well, if it is a material amount, you can't provide payroll services here. So think about what you can do and what you cannot do, but it's not to your audit client because there you may not provide any bookkeeping services, but to another division or a related entity you can, as long as it will have no material effect on your financial statements. Valuation services. You may not provide valuation services if the valuation will have a material effect. Remember, for a normal audit, you can do it as long as you've got safeguards in place. For a public interest entity, if it's going to have a material effect on the financial statements, you may not provide that valuation service. Tax. You may not prepare tax calculation of current or deferred tax assets or liabilities. You may not do it. If it's immaterial, which I don't think you will ever get to this situation, or very seldom, immaterial. Remember, it's not because they have a tax loss or a assessed loss that the amount will be immaterial now. No, it's not about that. When you can apply this, I really don't know. I haven't thought about that far when this will apply. But they say if the preparation of the tax calculation of current and deferred tax are immaterial, use professionals who are not team members to perform the service and use an appropriate reviewer. I don't know, because all of your public interest entities and your statutory audits, all of them, most of them will apply IFRS. I can't see that this will be an immaterial amount anyway, or a small calculation or an easy calculation to do. So I just want us to stick to the rule. You may not assist the client with a public interest entity to do tax calculations, not their normal tax, not their deferred tax assets or deferred tax liability calculation. It's a no-go. You may not provide internal audit services. Okay, may not provide internal audit services that relate to a significant part of the internal controls over financial reporting. Now, if your internal audit checks the controls in place that are usually relevant to our audits, I can't see that you will ever be in a position where you're going to provide internal audit services where it's not going to deal with controls over financial reporting. If it's not controls over financial reporting, yes, then it's fine, you can do it. But if it's got to do with financial reporting, you cannot provide these internal audit services. Information technology system may not provide any services involving the design or the implementation of IT systems. Again, that forms a significant part of the internal control over financial reporting. Or generate information that is significant to the client's accounting records or financial statements. Remember, normal audits the only thing that you may not do, you may not use the person who was responsible for that on the audit team. In a public interest entity, you may not provide that service. Litigation, I'm just going to skip. Recruiting services. Basically, the recruiting services now for our voluntary audits, other audits, and our public interest entity audits, they are now exactly the same. You may not provide the following recruiting services with respect to a director or an officer or a person in senior management in a position to exert significant influence over the preparation of the accounting records, searching or seeking out candidates for such positions, undertaking reference checks of prospective candidates for such positions. So I'm just going to recap here again. You may not do it now for voluntary audit clients, other audit clients, and you may not do it for public interest entity audits. That is one of those subtle changes that if nobody tells you about it, you're going to miss it in the new code. All right, so just take note of that. You need to check your fees on a public interest entity. If the fees for 2 years in a row is more than 15% of the total fees in your firm, you need to disclose it to the management, those in charge of governance. And you either need to do a pre-issuance review or a post-issuance review. Pre-issuance is an EQCR. There you need to appoint an EQCR. So prior to the issuance of the audit opinion on the second year's financial statements, a registered auditor who's not a member of the firm must perform an EQCR. So you need to go and find an EQCR outside your firm to review that work if for 2 consecutive years the fee is more than 15% of the total fees in your practice. Please just remember that. When the total fees significantly exceeds 50%, then you need to think that every year after that you need to do a pre-issuance review or that a pre-issuance review. If it continues to exceed 50%, every year after that you need to do a pre-issuance review. Pre-issuance EQCR review. Okay, so check your. Don't let IRBA come in and do that calculation. If you got a public interest entity, go and do that calculation. Must be maybe one of your big clients. Maybe the fee is more than 15% of total fees. You have to do that calculation. Don't let IRBA catch you out on that one. I am not going to talk about RIs today, reportable irregularities. All that I want to say is I want you to make sure that in your audit files, you've got a document, a schedule. You call it Schedule of RIs and No Clause. Doesn't matter what methodology you're using, you need the schedule in your file. And every time that a person is dealing with an audit, all trainees must be familiar with this. If you don't have this in your manuals already, in your files already, go and create a standard document in your firm. And if they find any indication of a no clause, non-compliance with laws and regulations, it doesn't matter how minute this is. It doesn't matter how small that amount is or how small the unlawful activity is or they think it is. It must go onto a schedule of RIs and no clause. At the end of the audit, all of these RIs, potential RIs, so we call it potential RIs and no clause, must be on that schedule, and each one of them must be considered whether it's an RI or whether it is a no clause. Very, very important. If there is an indication in a file somewhere, even if like the client did not submit its VAT return for 3 months, don't leave the trainee to make the decision if it's an RI or not. Put it on the schedule of RIs. You have to go through the process of elimination to see that it's not an RI and it's not a no-CLAR. So these things has caused a lot of problems for practitioners because people, trainees, leave it on the working papers. We never go back. We miss it on a working paper. It doesn't end up in a schedule. We never consider whether it's an RI or a no-CLAR. And at the end of the day, then everybody is in trouble. So what I'm going to do now is I'm just going to skip over this. I actually want to go to my whiteboard and I'm just going to do a quick presentation on the no-CLAR things and the RIs and the interaction between RIs and no-CLARs. In terms of RIs and no-CLARs, the process is much more complicated than we think it is. You cannot read RIs and no-CLARs in isolation. You need to look at these things in combination with each other. So there's 3 things that you need to consider. And I'm only talking audits here. I can bring in independent reviews as well. But today, the purpose of this course is not really to go through all of these RIs and no-CLARs for all the different type of engagements. We do enough other courses where we talk about this. So I'm just going to give you a brief overview here of how to read these things together and to show you that you cannot do this in isolation. And then after that, I'm just going to take you through the manual quickly to show you some of the appendixes in that manual just to highlight to you how you're going to design your policies and your procedures. So what's the way forward now before the 15th of June? That is what I'm going to show you just after I'm doing my RI and no-CLAR presentation. So the 3 things that you need to consider, we might as well just bring in the independent review because all 4 you need to read together. Your starting point is ISA 250. ISA 250 is the standard, the international standard on auditing that says during the audit or the independent review, it is your responsibility. You, the auditor or the independent reviewer, must find no-CLARs. You must find non-compliance with laws and regulations. That is the triggering point. This is where everything starts. Now, ISA 250 says that when you try to find non-compliance with laws and regulations, your starting point is you shall ask management. It's always a thing of ask and find. You need to ask management what laws and regulations do they need to comply with, and then you need to go and find any non-compliance yourself. Right, so there's processes that you need to follow here. That's just a very short summary of what the standard requires you to do. The standard there says if you find instances of non-compliance, what you're going to do is you're going to split your working paper in 2. You're going to have a list of acts that will have a direct effect on the financials, and you will have a list of acts with an indirect effect on the financial statements because the audit work that you're going to do on the 2 are different. Direct, for example, will be your VAT, let's say pay as you earn, your income tax, for example, all of those things that will have a direct effect in doing the calculations on the financial statements. And ISA 250 says to check for non-compliance, you need to perform audit procedures to obtain sufficient, appropriate audit evidence. What does that mean? It means that you need to do audit work and obtain evidence that there is no compliance. That's normal audit work. I mean, like me and you understand what an audit is. That is what you need to do on the acts that will have a direct effect. On acts that do not have a direct effect, that is, for example, your labor acts. Okay, it's something like the Financial Intelligence Center Act, PRECA, POCA. Don't worry too much about all these things that I'm talking about now. But what this can lead, if they do not comply, if they are obliged to comply with this and they do not comply with it, it could lead to huge penalties. It could also lead to closing down the business. Let's look at an example. FICA says if you're an accountable institution, you must be registered with the Financial Intelligence Center Act. If you're not registered or you register late, the penalty is 10 million. Okay, so that 10 million could cause a material misstatement in the financial statements because this needs to be properly disclosed to the shareholders. But it must also be reported somewhere because the client did not comply. It must be reported. So one of two things can happen here. You're going to say, I'm happy or I'm not happy. Both of them. Happy, not happy. Client, yes, they registered. I'm happy. I checked that they registered. No, the client is not registered. I'm not happy. So maybe I need to report. So for RIs in an audit, you're going to look at section 45 of the Auditing Professions Act. And for an independent review, you're going to look at Regulation 29 of the Companies Act. There's a definite, immediate reporting requirement here. Immediate. If you meet the definitions of an RI in the Auditing Professions Act and the RI in Regulation 29. Briefly, an RI that needs to be reported immediately is an unlawful activity. Any contravention of any act is an unlawful activity that is material to the shareholders, to the creditors, to the employees, to anybody that's dealing with that company. And it must be on a management level. So it must be an unlawful activity that will have a material financial implication for anybody dealing with that company. Same for the Regulation 29. Also unlawful activity, material financial loss. There was a material financial loss, or in future it could cause a material financial loss. So you look at it in the past, did it cause a material financial loss? Or you look at into the future, can it cause a material financial loss? If so, past and future, you're going to report it as a RI. And I say immediate. You don't wait. You're not going to give your client a chance to fix the problem. You must immediately report it. The next one under an RI for IRBA is fraud. All fraud. It doesn't matter how big or how small it is. It needs to be reported. Fraud, your client paid a bribe of 2,000. It's definitely not material, but that 2,000 can cause the client to close down the doors if somebody becomes aware of it. Also for your Regulation 29. In an audit, it says here a breach of a director's fiduciary duty. A director did not act in the best interest of the company. The director made a profit on the side for himself. Anything that you can put under that one, it's an immediate report to IRBA. This is an immediate report to IRBA. In an independent review, any insolvencies, this is your commercial insolvency and technical insolvency. For example, if the liabilities exceeds the assets, it needs to be reported to the CIPC. There's a strict period that you need to follow, 2 letters that you need to send. I'm not going to go through that process now with you because I want to get to no clause. Just a big difference between this and no clause. This is what you're going to put on your schedule. You're going to go through, if you do an audit, you're going to have it on your schedule and say, is this an RI? If you go through the definition, you say, yes, it's an RI, you're going to go to and report it immediately to IRBA. If you say, no, it's not an RI, now it's a no clause. Then you're going to move over to no clause. Now, a no clause here is in terms of the code. Now, I just quickly want to show you something. In your course material, I gave you everything about the no clause that you need to know about. Okay, So it is in the new code 360, but it's still 360 in the new code that you need to work through. The wording is different in the new code, but everything basically stays the same. All right, that is why I'm not going to go through all the wording. Whatever you know about no clause, that stays the same, although the wording has changed. The whole layout has changed. But what is a no clause? A no clause is that if you become aware of non-compliance, that is if you don't do an audit, let's say, or you don't do an independent review, so you do other type of work, accounting, tax, consulting, whatever work you do, you become aware of a no clause. The very first thing that you're going to do is you're going to discuss it with the client. We call it a delayed report. That is how I like to call it. Delayed, not immediate, delayed, because here you're going to discuss it with the client. You're going to give the client time to fix. The code does not say how long do you need to give the client to fix the problem. You need to use your professional judgment to determine how long will it take the client to fix this problem. What will be a reasonable time for this client to fix this problem? Then you're going to go back and you're going to look at their response. How did the client respond to this? Did they fix it, or did they just say, oh, we're not going to fix anything. We don't care. We're not going to comply. We're not interested in listening to you. If you're then not happy with their response, so let's say here it is about the response of the client, the response. You're happy with the response, you can stop. If you're not happy, you have to consider reporting it. Not to IRBA, not to the CIPC. Let's say it's a tax matter. You need to report it to SARS. So it depends on who is the regulator for that specific matter or for that specific client. Who's the regulating body? Who oversees that industry? That is where you need to report it to. That is only if you're not happy. Now, in the code, it does say that there are certain things that don't need to be reported. And that is why you need to work through this process of elimination to see if you need to make a report. It does say that if it's very trivial, if it's very small, like for instance, my example where the client for 3 months didn't submit the VAT returns on time and they had to pay penalties. Yes, it's now clear. It is non-compliance with laws and regulations. But they did fix it and they stopped doing it, and when you spoke to them about it, they fixed it, they submitted the returns, everything was fine. You can say, well, you know what, it is so small, it is not really a big problem. So yes, it's a no clear, but I don't have to follow the process here. But remember, you need to document your reasons for not following the process. Also, if it's got to do with a personal matter of a client, let's say I'm a director in a company and I decide that as a director in my personal capacity, I'm not going to pay my toll fees. So I have this discussion with you and I say, I refuse to pay toll fees. You say, oh, okay, Lynette, sorry, now I'm going to report you. No, you don't report me if it's something that it relates to me personally. That is what the code says. But if I decide that I'm also going to make my issue the company's issue, and I say the company is not going to pay toll fees, so I never pay the toll fees in the company, then it is a no clause. Then you're going to report me to SANRAL. Okay. But if it's my own personal issue, you don't have to report me. Also, when you are appointed as a third party, so for example, you are called in to do a forensic investigation or let's say forensic investigation, and you detect no clause. You in as a third party, you need to report directly to that auditor. You're not going to make the report. You need to go to that client or person auditor and make the report to the auditor, and then the auditor needs to then determine what to report. So there are quite a few rules that you need to comply with. Then there might also be another reason why you're not going to make this report, and that is because your life is threatened. So If you feel that if you're going to make that report, your life is going to be in danger and your family's life is going to be in danger, the code says that you don't have to make that report. But obviously, you need to make sure that, you can't just use that as an escape clause, because otherwise you're going to get in serious trouble if you do not make these reports. Your life must really be in danger. There are very valid, good reasons why you state in your file that you're not going to make that report. And all of these things that I'm talking to you about now should go onto your schedule that I told you you need to create. If you don't have one yet, make sure you've got the schedule so that you can work through these processes and make sure that you don't slip up. Remember the penalties here for not reporting RIs, either I think it's 10 million or 10 years in jail for not making RI reports. All right, so please just make sure that you understand the rules, that you are familiar with these things, how these things work, especially the new no-CLAR process. When is it an RI? When is it a no-CLAR? We do have separate recordings where we explain this in much more detail, where we spend a lot of time on this. If you're not quite sure about all of these things, please order those recordings and make sure you understand this, because the penalties for this is really, really harsh. Okay, so everything that I've talked about now in general is under this no-CLAR things here. Examples, consequences of not complying, fines and litigation. Okay, what is excluded? All of confidentiality, we spoke about that. The process that you need to follow during an audit. Okay, so are you happy with management responses or not? All of these things are explained here, and it's also explained in this manual that you need to have. Now, I've got a few minutes left. I just want to go back to this manual because, yeah, we've got a new code, and I told you that the implementation date is now the 15th. What is the way forward? What do you need to do now about it? Okay, the very first thing that you need to do is you need to bring in your new policies and procedures. Let me just scroll down to the area. You will see that everything that I've got in red here are the new policies and procedures. So you need to have a policy on all of these things, and then you need to say, okay, what is my safeguard that I'm going to apply? So all of these things you need to have in place, and you need to design your own policies. Also, what I did here is I highlighted to you if it's a South African requirement so that it also stands out. This manual does follow the presentation that I did today. So number one, you must have new policies and procedures in place. Number two, all your staff needs to be retrained. You must have evidence that you retrained all your staff on the new code. Please make a note. They will want to see how did you retrain your new staff on this new code. To assist you with this, there's also a lot of appendixes here. I just want to quickly go to this just to show you. There's all the appendixes. Now, what the big deal with this is that if you've got a policy, you need to implement that policy. And you need to document to show that you've implemented it. Now, these annexures that we've got here will then help you to implement those policies. For example, you need a declaration by staff members that have access to the firm's policies and procedure manuals. Everybody needs to know where is this manual. They've got access to it. They know what the content of the manual is. They need to confirm the firm's understanding of policies and procedures. You need to keep attendance registers for training purposes. You need to have somebody accept the role of who's going to be responsible for quality control, who's ultimately going to be responsible for it, and who's going to be responsible for the operational side of things. It can be two different people. It could be a specific person that you appoint that's not a partner, but somebody that you appoint in your firm that's going to take responsibility for all of these things that we were talking about now. Annual ethics and independence declarations by staff, declarations by partners. independence and confidentiality undertakings by third party, confidentiality statements. So for everything that I talked about today, you need a policy on it, and you need to show the implementation of that policy by way of a document. Now, you can have your own documents. So, for example, in many of these instances, you are using a methodology. And then you just need to make sure that you refer to that methodology in your policies and procedures manual to say, I am using this document in this methodology to show implementation of this policy in my manual. Okay, so whatever you do, 3 things then. You need the policy on everything that I talked about today. You need to have training done on your firms, for all the staff members, retrain all the staff members, and make sure that you implement your policies. There's a lot of things that you need to change. Again, I will not advise you to, what do they say in Afrikaans, spoeg en plak your old manuals. I promise I tried it. It's not going to work. It's a rewrite of that whole manual. Yeah, so those are the things that I wanted to bring to your attention. If you use methodologies, obviously everybody is now frantically busy updating their methodologies as well to make sure that they comply with the new standards, even if it just references to, even just the reference to the name of the codes. I mean, that has changed. You can't refer to the old code anymore. You need to refer to the new name. So even your methodologies needs to be updated here. All right, so guys, there's a lot of hard work that is lying ahead for you. We are trying to assist you in the best way possible to help you with the implementation of this. So if you do have any questions about implementing, please let us know. We've got a lot of information that will assist you with this. The manuals are available. Just remember, you can never ever, whatever policy manual you buy, you may never ever just buy the manual and print it out and put it on your shelf or put it on your server. You have to tailor. So it is not just a matter of buying the manual and let it gather dust somewhere. There's a lot of work to do. Don't wait too long. Don't wait too long. Start immediately so that you are ready by the 15th of June. So from my side, I want to say thank you very much for attending. Goodbye to everybody. Enjoy the rest of your afternoon and good luck with your implementation.